Good morning, good afternoon, and good evening to all colleagues. Welcome to this event. Excellencies, distinguished delegates, ladies and gentlemen, I'm pleased to convene you today at this high-level meeting on the role of credit rating agencies in the implementation of the 2030 Agenda for Sustainable Development. I thank you for attending this important discussion. We are at an important point in the delivery of the 2030 Agenda, about halfway to 2030, the target date for our global sustainable development goals. Yet, financing is proving to be a critical bottleneck. Now, global markets are tightening, increasing debt servicing costs, and pushing a rising number of developing countries towards unsustainable external debt burdens. Amid the increasing concern, it is fortunate that last year, in the outcome document of the ECOSOC Forum on Financing for Development, member states asked for more research and analysis on the role of credit rating agencies. Credit ratings play an important role in international capital markets as they provide information to investors. Their assessments of debtors' relative risk of default are part of the information ecosystem that undergirds capital markets because they influence the cost of borrowing and thus the cost of investment. The actions of credit rating agencies are of concern to all stakeholders. My department, DESA, has produced a policy paper and a policy brief on these concerns. I hope you all will read these materials, including proposals for reform. As you know, the Interagency Task Force on Financing for Development has also examined this topic and will issue the 2022 Financing for Sustainable Development in mid-April. As the chair of this Interagency Task Force, I share the concern of many stakeholders on this issue. The task force held important technical discussion last year among its agencies, including the IMF, the Financing Stability Board, the UN system. Now I'm delighted that we can broaden the discussion to include member states, ratings agencies, regulators, investors, and other stakeholders. I welcome you all to this meeting. Now, we are so delighted and we're so honored to have our Deputy Secretary General of the United Nations, Amina Mohammed, to join us, and who is going to deliver a keynote speech to open this meeting. Amina, you have the floor, please.
Thank you very much, Mr. Liu. Excellencies, distinguished delegates, ladies and gentlemen, I'm really honored to be speaking here today at this timely and important event, and especially to be doing so together with Mr. Liu, Under Secretary General for DESA. As new risks emerge, the global outlook is becoming increasingly fragile and uncertain. The conflict in Ukraine is adding to significant pressures in the world economy. It's sending fuel, food, fertilizers prices skyrocketing, and doing so at a time when most countries are still struggling to recover from the impacts of the COVID-19 pandemic, let alone prepare for the impending climate crisis. As with the pandemic, developing countries continue to bear the brunt of this crisis, a phenomenon that history has shown time and time again will only widen inequality while sowing seeds for greater unrest and conflict. For many developing countries, the pandemic has worsened fiscal positions, triggering a wave of sovereignty rating downgrades, higher borrowing costs, and intensified risks of debt distress. This has impeded countries' ability to finance their pandemic response and to invest in a more resilient, sustainable, and inclusive future. Many are facing a lost decade
Your video is not
of
on yet, but
sustainable
that's fine.
development.
You don't need your video on.
Okay. But developing countries do not necessarily need to carry the burden of our world's collective crises. This is, first and foremost, a policy choice, which can be resolved by taking a hard look at our broken global financial architecture and the mechanisms that keep it running. Against this backdrop, the role of credit rating agencies could become instrumental partners in reforming this global architecture to reduce inequalities and to achieve the 2030 agenda. The upcoming 2022 Financing for Development report points out that even after adjusting for market risk and defaults, sovereign borrowing in foreign currencies has historically been expensive. Governments pay higher interest rates compared to other borrowers, such as corporate bonds and equities. There are a wide variety of drivers behind why the cost of borrowing for some countries is so high, but questions remain as to whether improved availability and quality of information could help reduce the cost of borrowing for governments. This is desperately needed for them to have resources to survive the world's current interrelated and cascading crises, while trying to bolster resilience against future shocks. This includes urgently needed investments in social protection, in education, health, climate action, and other emergency needs. In this context, the question we'll focus on today will be what role can credit rating agencies play in this effort as partners? Since the 2008 global financial crisis, much progress has been made to strengthen the contribution of the credit rating industry to the 2030 agenda. In several economies, including the United States and the European Union, significant reforms have been made to eliminate the mechanistic reliance on ratings in most financial regulations and to try to address the conflicts of interest that arise the issuers pays more model of credit ratings. Yet, there are still concerns around credit ratings of sovereigns. For example, during the pandemic, developing countries bore the brunt of credit rating downgrades, despite experiencing relatively milder economic contractions. There could be many reasons for this, including economic fundamentals. But the appearance of bias hurts both the ratings industry and developing countries. Perceptions have currency. In addition, the fear of rating downgrades hindered some countries' participation in official debt relief programs. This includes the G20's Debt Service Suspension Initiative and the Common Framework. This despite the fact that these programs are specifically aimed at raising debt sustainability in the medium term in order to raise credit quality. Moreover, fast evolving changes in technology, growing climate risks, and the increasingly complex linkages in the financial system have underscored the need to reevaluate the systems for producing credit assessments that reflect the changing global landscape. The United Nations has always strived to provide a platform for all voices and views and to discuss the barriers faced by developing countries in achieving sustainable development. This includes a history of discussing the role of rating agencies in the financial system. In 2013, the UN General Assembly held a thematic debate on the role of credit rating agencies in the international financial system. In 2014, the Economic and Social Council held a follow-up meeting on the impact of credit rating agencies on the financing for sustainable development. Today's meeting is a genuine opportunity for us to have an honest and open discussion on some of the most pressing questions. For example, what gaps are there in information and analysis necessary for accurate judgments of sovereign credit risk? What role can credit rating agencies play in improving the provision of information and analysis on sovereign credits? How are rating agencies adapting to the changing world, including to the changes in technology? And how can they best incorporate environmental and social impacts into ratings processes? Are longer-term ratings needed to better assess these impacts? Are the current regulatory regimes for credit rating agencies sufficiently attuned to sustainable development issues? And should we be doing more to help all stakeholders better understand sovereign risks? I hope that this dialogue will help in advance thoughtful discussion and meaningful policy solutions to improve on the existing credit rating architecture. This could also enhance the ability of credit rating agencies to contribute to a more stable international financial system, one that provides a solid foundation for sustainable development. I know that together, credit rating agencies can become our key partners in forging a more equal world while protecting the most vulnerable. I wish you a successful and a productive meeting. I thank you.
On behalf of all the participants, I thank DSG Amina Mohammed for her joining us and delivering this important keynote speech. Madam DSG, I think I know that you are busy. You have to leave for the office to take care of many of the issues that you are confronted today. We understand you will leave for us. Thank you very much once again. We are going to follow up many of your recommendations and comments. Dear colleagues, you have heard the keynote speech by DSG. I think for this morning, we are going to organize our meeting into two panels. So we should be, the first panel is going to discuss the issue, the role of credit ratings in long-term finance for sovereigns. And the second panel is going to discuss the institutional ecosystem for promoting stable and sustainable finance. So we should have a very, very focused discussion on these two issues. I think that because you know that our world today is confronting not the traditional, normal financial challenges, but also these new challenges that emerge in some part of the world. So I hope that we should have a very, very focused, devoted discussion, and you are going to advise us how we are going to move forward. The issue is not to the concern of UN, but also to many member states. I think that's why we have tried to invite the panelists as well as participants from all stakeholders. So this is a multi-stakeholder discussion for the morning. With these words, I think we are going to, after that, the two panel discussion, we are going to have a closing. I think there will be closing remarks for that. I shall ask my colleague, Naveed Hanif, Director of the Finance for Sustainable Development Office, to take care of the whole process. I think follow the whole process and to deliver the closing remarks. So with these words, may I pass floor to Professor Stephanie Griffiths-Jones from Columbia University, who is going to moderate the first panel discussion. So Stephanie, now floor is yours to lead the discussion of panel one. Thank you.
Stephanie, please unmute yourself. We can't hear you.
You need to unmute yourself.
Sorry, can you hear me?
Yeah, no, it's
Can you
fine.
hear
Yeah.
me now? Yes. Thank you very much for the kind introduction. I'm very honored to be chairing this session with such distinguished panelists, whom I will introduce immediately, shortly. I should just mention that I'm Stephanie Griffiths-Jones, and as was mentioned, I'm Financial Markets Director, Initiative for Policy Dialogue at Columbia University. And I should also mention, even though I'm not yet in office, I have just been appointed starting the 1st of May as board member of the Central Bank of Chile, but I'm speaking in my former capacity as an academic. I would just like to say a few words, really emphasizing some of the crucial points that Undersecretary Amina Mohammed made about some of the problems that exist with credit rating agencies, and which we also detected in a paper we wrote with Moritz Kramer, which has been recently published by you and DESA. And some of these problems include the pro-cyclical nature of credit rating agencies, the fact that, as Amina mentioned, there seem to have been, particularly in the last COVID crisis, far more significant downgrades and far more common downgrades for emerging and particularly developing countries than for developed ones, even though the former countries have effectively been less affected in terms of growth. There's also a third concern that credit rating agencies do not consider enough long-term factors, such as impact of climate change and climate risks for all economies, nor do they take enough account efforts of countries to build up their resilience and adaptation to climate change. And there are also issues like possible conflicts of interest. But I think, as I understand it, this panel is more on the topic of what we can do, how we can jointly all improve the architecture of the credit rating agencies. And this, of course, requires, as was also said, a multi-stakeholder approach. And I think it's great that the United Nations is convening this high-level meeting for this purpose. So without further ado, I'm asking them to talk about the role of credit ratings in long-term finance for sovereigns. I would like to ask the following speakers to talk about 7 to 8 minutes. I'm very honored to present His Excellency Mr. Ken Ofori-Atta, Finance Minister of Ghana. He's so well known that he doesn't really need more introduction, but his CV is on the website. And I would like him to particularly, if he could, address the two following issues. The African region has some of the highest development investment needs in the world, and yet it is also a region that pays the most for external borrowing. And secondly, and perhaps a little bit indiscreetly, Ghana's sovereign rating was recently downgraded by major credit rating agencies, a move which you have criticized. So if you could kindly comment on those two aspects in your first 8 minutes, we would be very grateful. Minister, the floor is yours.
Okay. Hi, good afternoon from here. It's good to be at this panel, and really thank you for the UN for setting this up. It's extremely important, and maybe just to illustrate right from the back, if we look at our going to market a couple of years ago, in which I guess our cost was about 8.5% yield, and then Greece had about 1.88. It just leads to maybe a $50 million gap per annum, for a 10-year instrument would be about $500 million more for the poorer country to pay. But actually, if you look at the whole flow, we might end up paying 2.6 billion dollars versus Greece's 1.6 billion, and that is really a lot of money for a developing country, where we acknowledge that to even get back to our pre-COVID times, we are going to need about $425 billion to do that. And for us in Ghana, if we look at our SDG needs, that's another 522 billion for the period that is left. So rating agencies then have an enormous impact in literally the leakages that Africa has to contend with going forward, and the cyclicality of it becomes quite problematic, and especially when you look at this rather cataclysmic period of COVID, basically compromising your socioeconomic activities. It brings reason to pause as to the methodologies that are used, and really how best to make the rating agencies useful for the real import of why they exist to ensure that there is fluidity in the supply of liquidity, because the world is really not short of resources, and are the rating agencies facilitating the distribution of that, or it has moved into a space where it's actually curtailing or making it, inaccessible, either of cost or whatever. And I think those are the fundamental issues that we need to contend with. And so we got downgraded, and that was quite a seismic shock in and of itself. And we did appeal to Moody's about that, because even in their own assessment of giving us stable for the future outlook, but then downgrading us to CAA1, it's sort of counterintuitive if one is looking at the totality of a country's, forward movement. And I think the statistics also, in terms of African nations, that we are least likely to be upgraded if you look at the history of what is happening around the globe than otherwise. And I think during this period, we might have gotten about 22 or 23 countries downgraded over that period. So is this a status quo that should be accepted? Is there any way in which we can work with the rating agencies to look at the integrity of the methodology and not really create a situation where we talk about a free market system, but a free market system that really does not help a certain group of people in the world. So those become the deep worries about that, and the AU is taking a really serious view about what to do for Africa. And I think a lot of the situations also occur because Africa is not necessarily at the table, and the voice is not heard enough to impact what it is that we are looking at. 50 million youth. So we need to really look at the foundations of this whole financial architecture if we are to reset and recalibrate and really enhance global prosperity. So for me and a lot of the African finance ministers, the issue of recalibration, the issue of voice, the issue of who watches the watchman, how to make this more efficient and not continue to talk about inequities, but that should also be stooped in deep research and really give, in a sense, Africa the opportunity to breathe. And now you can imagine that with the Ukraine crisis, it has even further accentuated problems that African finance ministers have, even post-COVID. So this is really an urgent call to arms, and really pleased that UN has recognized that we should be looking at this with all seriousness, a sense of urgency that will impact this continent of 1.3 billion people. Yeah, so because credit rating agencies, in effect, are de facto decision makers and influence, the resource envelope that can come to our countries, even as we manage the crisis more than anybody else on the continent. I think there are about 300,000 deaths that occurred on the continent, and Ghana is about 1,400. And so what credit is then given for saving lives and livelihoods, which puts you in a difficult financial position going forward. But in terms of the sense of the common humanity that we should all share, you seem to be punished for that. And those are the issues that should be brought, squarely into the ambit of sovereign ratings. So the call for ratings reform was loud during the peak of the COVID-19 pandemic, but must not be normalized in any way. And that fierce sense of urgency must be brought to bear. So we need a more informed dialogue and discourse between governments and credit rating agencies. And really, we are all fallible. We may be comfortable with what we believe to be the formulation and whatever, but truly, you have a different lens on, and suddenly you see possibilities that would affect the reallocation of resources around the world, which would enhance the productive engine of the continent. So I think it's critical to address this and the challenges of this low credit rating that Africa perennially has, and an inability to move up the scale, but much easier seemingly to come down the scale. So the consistent scientific methods of risk assessment that do not disadvantage our countries on the continent. And if CRA are overly reliant on unquantifiable judgments, which are often carried forth from early assessment, then how can governments argue the counterfactual in a sense? And if really we also acknowledge as human beings institutional biases and discomforts, then how should Africa be at the table and be a voice so that people are familiar with us in the assessments of what we do, and reduce, internal biases that one may not even know is occurring, but it's easy to get through your board or credit committee. We also have to explore credit guarantees and other credit enhancements from multilateral agencies and bilateral donors. But we have an example of a wraparound transaction, which also made no difference to the pricing, but they took that in, and the paper sold. So there's a lot of distortions, but truly in the end, discussions and good order, common humanity, etc., understanding where the world is going, and each institution's clarity on why they originally came to be in the first place, I think will lead to a better way of evaluating African ratings going forward. So let me thank you very much for this, and I pray that we will move very expeditiously on this after this meeting. Thank you. I think you are muted. You can hear.
Sorry, I don't know why it always does.
We can hear now.
Thank you so much, Minister, for your eloquent and such clear presentation. I think I'll just stress a couple of points which I think are very central to the debate. One is you emphasize the sense of urgency. We cannot just study and do research and discuss in fora, but we need action now. Secondly, you raise the issue of voice. When I started studying the international financial architecture, all these bodies were G7, G10. We have now made some progress because they're G20, but they still have a major weakness that they are only G20 and there is no representation, as you pointed out, in any of the key bodies, regulatory or otherwise, of small, low-income, and particularly low-income or low-middle-income countries. And I think that is a major failing of the international financial architecture, which then is reflected concretely in the way, for example, credit ratings are regulated and managed. And more broadly, I think regulation is mostly strong, relatively strong in developed countries. I think there is practically very little voice for regulators from or governments from developing countries. And I would also argue that regulation is in general weak of credit rating agencies, although they are such key actors, even though they don't actually disburse money, but they have, as you pointed out so clearly, such a big impact on the volume and the cost of credit to so many countries, and therefore affect the lives of millions of people. And finally, I think very importantly, you stress the asymmetric way credit ratings are adjusted, that they can be downgraded very quickly, usually during crises when countries need money most, and then they're very slow to be upgraded. I think that's one specific point that needs to be looked at. So thank you very much for your powerful intervention. And now we're very lucky to have Mr. Hiro Mizuno, who's United Nations Secretary General's Special Envoy on Innovative Finance and Sustainable Investment, and who has a long previous also experience with rating agencies, because he was formerly the Chief Investment Officer of the Government Pension Investment Fund of Japan. So I would like to ask you first, with the lens of a long-term investor, what do you see as the role and the impact of credit ratings? And secondly, perhaps even more important, what do you think can be done to strengthen the information ecosystem, and especially, specifically the credit rating agencies, to promote long-term investment, which is so badly needed? Thank you very much. If you could also give us 7 or 8 minutes of your wisdom, Mr. Mizuno. The floor is yours.
Thank you, Stephanie, and thank you, DESA, and ladies and gentlemen, and Excellency, to invite me to speak at this very important, the discussions on the role of credit rating agencies. As I've been just introduced as the former Chief Investment Officer of the Japanese Government Pension Investment Fund, which is the world's largest pension fund. And at the time of my management, it had $1.7 trillion, asset under management. So we are the biggest asset owner in the world. And even for such a big asset owner, I always felt that we won't be able to really mobilize capital in the way we wish without having the credit rating agency plays bigger role or change the way they rate issuers. Because I'll give you some example. The Government Pension Investment Fund has a very clear mandate from the government to make the investment into the global debt market, but it comes with a lot of guidelines or restrictions, which includes the how much we can rate in rated the issuers and also the unrated issuers. And on the top of that, we had a very strict guideline how much we can invest in non-investment grade issuers. And as you can see from the statistics, it used to be, we had more trouble with the coverage by credit rating agencies in the developing markets. But now, 35% out of 54 African countries now has the credit rating by at least one major global credit agencies, and the 41 out of 50 Asian countries now have the credit rating from the major credit rating agencies. So coverage is no longer an issue, but the gap in investment grade rated issuers and non-investment grade rated issuers has been quite significant. And as you can imagine, most of the African and the South Asian developing countries are rated as a non-investment grade, as known as junk bonds. So when I was running a GPIF, I tried to expand the GPIF's the global sovereign debt exposure into non-investment grade issuers. We got a huge pushback from our own governance and the government, including the Japanese, the pensioners. They are very concerned about risk, too much risk the GPIF may be taking. So I think the coverage is no longer issue, but the percentage of the issuer who are rated as an investment grade still casting huge, sort of like a restriction or, plays restrictive role in the way the big asset owners, pension fund shift the money into development countries, where for us to achieve the SDGs, most of the money have to flow into development countries. I mean, according to IMF, we talk about we need the $2.5 trillion a year, and a 2/3 of that have to flow into developing countries. And I also attended the COP26 to promote the G funds, and where the 450 institutional investors gathers to make a commitment to make their portfolio net zero. But the problem is less than 10% of those huge amount of money managed by those institutions currently allocated into the developing countries, and for those to increase the exposure, they need to deal with the credit rating, because now their own governance constituency, as well as for the banks, the financial supervisory agency, they all use the credit rating to calculate risk-adjusted capital of those asset owners and the banks. So it's very critical. And then issue I have observed is that we have seen many discussion convened by UN, and we hear a lot of frustration and a lot of kind of see a lot of unfairness in the way that the developing countries being rated. But to be honest, that the rating agency has a very unique business model. They are paid by the issuers, including a sovereign, developing countries sovereign, but they don't perceive them as a real customers. For their perceived customers are investors and banks who use their their ratings, and for the asset managers, unfortunately, they have no incentive to ask the rating agency to, to rate the developing country or any debt more generously, because if the rating is low, investors can prove they can make extra return out of that rating. So there's no incentive, systemic incentive for their perceived customers to put ask the rating agency to review the credit rating to really reflect the risk and return. And so I think what we need is, we probably need to have a forum to discuss that. We cannot put the pressure to some agency from the from the side they don't perceive as the real stakeholder or the customer. So I think we just need the users of credit ratings, like investors, the banks, have to make their statement clear that it's actually missing opportunity for the investors, or preventing investors to shift more money into sustainable project, or make the whole the global capital market more sustainable. So I think that we just probably need to have a different dynamics in our discussion. And the third point of the how we can make that the ecosystem or information system better work for the long-term investment. I think the ESG movements in a stock market or like in the area of stock investment really gave the opportunity for investors to shift the money into more long-term agenda or long-term value creation. And I'm hoping that the ESG is going to now integrate in debt investment as well. But the debt investor, professional ones, including fixed income, the asset managers, their mandate from their customers are very clearly linked to the how their portfolio should be rated by rating agencies. So they have to demand that the credit rating agency to give them either integrate the long-term sustainability factors like ESG into the credit rating, or provide some other ways to adjust the rating to serve the purpose of the investor who wanted to bring in more long-term sustainability focus the investment into the bond portfolio. So I think the some of the the rating agencies started providing like ESG rating, but it hasn't been very comprehensive yet. And on the top of that, it doesn't so far help the investors really decide which project they can finance. Because one of the issues I have observed throughout my time as the professional asset manager or like asset owner is, they only give one rating to the one sovereign. But if we wanted to promote developing country treasurer or the government to invest more in a sustainable project, a sustainable infrastructure, we need to find a way to differentiate the pricing or differentiate the cost of their borrowing. And at this point in time, we don't have it. But if we have the credit rating agency to take this seriously and investor, the work with them to find a way to differentiate the project under, by the same issuer, that's going to be the real game changer. So I gave several ideas or several observations from my previous role, but in my new capacity as a special envoy, I'm actually talking to the credit rating agency and their perceived customers to find out if there any effective way to do that. But that's the, I just wanted to share with you. This has been very complicated, systemic failure of incentivizing the agents, and also the having the stakeholder to raise a voice to work for the common goals of SDGs. Thank you.
Thank you very much. Can you hear me? Yeah. Thank you very much for really making such excellent points. This is not the first time I hear you, and I always learn so much because you give such valuable insights, also from inside the industry. If I may, I would briefly summarize some of the key points you made. The first one is that there should be a forum to discuss this more integrally, and that should include also the users of credit rating agencies. I think this is something that maybe the UN could work on, and also emphasizing the role of sustainable projects. And you emphasize the great opportunity that ESG offers, but that this needs to be integrating into the world of rating agencies, which is not done, I think, enough to, for example, differentiate pricing for projects that have a greater ESG content. And one idea that has been circulating is that if credit rating agencies cannot do this so much or not sufficiently, maybe there could be an independent credit rating agency that would focus more on these long-term aspects, and particularly on the ESG aspects. And I think that is one issue that could be discussed in the kind of forum that you have. I think the issue of incentives that you raised, of looking carefully at where the rating agencies make most money and how that can be combined with changing the incentives so that they can include both the needs of the planet and particularly also of the poor countries. I think work on the incentives is really important, and how that can be changed internally in the rating agencies, but also externally. I think it's very interesting, your emphasis, of course, on the institutional investors themselves, the links with the rating agencies and the rating as a criteria, and your emphasis on the fact that only 10% is allocated to developing economies when they represent almost half of the world's GDP and probably a lot of the world's future growth. I thought it was particularly interesting, the points also that you made at the beginning. Coverage is no longer an issue, but very much the issue of non-investment grade, which has been blocking also progress on the debt relief initiatives, but also access to money, particularly in the face of the COVID crisis. So thank you again very much for your interesting contribution and ideas. So now we have our third speaker, who's coming from the rating agencies themselves. We have Ms. Marie Diron, who's Managing Director of Sovereign and Sub-Sovereign Risk, and ESG Project Lead. So she should give us all the answers from Moody's. And I have two questions for her, if I may. In your view, what are the main roles of credit rating agencies? Since the global financial crisis, credit rating agencies have made substantial changes, such as in increased transparency. What are some of the most significant measures that your agency has taken? One recommendation is to help investors better delineate the subjective part of ratings, which is really your value added from more model-based results. Do you think it is possible to make this separation? So with those two questions, I give the floor to Ms. Marie Diron. Thank you very much.
Thank you, Professor Jones. Thank you really to the UN for inviting us to these high-level meetings. It's really important, and really appreciate the opportunity to engage in this exchange of ideas and indeed identifying potential ways forward. To take your first question about how we see the role of rating agencies, I would summarize it as really our role is to provide transparent, consistent, forward-looking and independent assessment of issuers' capacity and willingness to repay debt. And these four objectives are very important, and each of them is very, very important. So I repeat, transparency, consistency, their forward-looking nature, and independence of views. And that is because we all operate, and investors and asset managers operate in a very uncertain world, certainly today, but in general, uncertainty is there and everywhere. And without adequate tools and information to take decisions in that uncertain world, then the risk is that investors retrench, in particular from emerging frontier markets, and in particular in period of economic and financial stress. And that, I think we would all agree, would have negative implications for economic and financial development. So we see here a role for rating agencies to help investors and asset managers make decisions under that uncertainty. And we've seen, to Mr. Misol's point about increased coverage, we haven't seen, indeed, in terms of sovereign ratings, our coverage increased very significantly. We today rate 145 sovereigns globally. That's up from 113 in 2010. And that really reflects the deepening of global financial markets and increasing access to finance for emerging and frontier market sovereigns. Now, how do we achieve this transparency, consistency, forward-looking assessment, and independence of view? I will start by emphasizing that our ratings are based on methodologies, and that's very important. These methodologies are public, They provide an anchor to our analysis, and they provide really an anchor to that consistency. So for instance, when we rate sovereigns, the methodology is set in terms of around 4 main factors. Economic strength, and a number of people have hinted at the growth impact of the pandemic. That is one factor, one element, potential growth and the capacity of the economy, the population to absorb shocks. There's also institutional and governance strength, very important. We've certainly seen that in the last couple of weeks. Fiscal strength, of course, the state of public finances, the debt burden, but also the affordability of debt, and susceptibility to event risk, under which we look at various elements: political risk, banking sector risk, risk related to external positions, as well as government liquidity. Under each of these, we take into account, we factor in a range of data, quantitative metrics, which are typically data that we source from country statistics offices, central banks, Ministerial Finance, as well as international organizations like the UN, IMF, or World Bank. We set our own forecast because, as I said, ratings are forward-looking. So it's very important that we project and we explain to financial market participants what our projections, our views of the future is. And we do integrate some qualitative judgment, because we believe that some aspects of sovereign credit profiles cannot be quite assessed entirely quantitatively, and there's space there for qualitative judgment. We update these methodologies regularly, and to the point about the transparency or the way we communicate these aspects of qualitative judgment, our last update of the sovereign methodology in late 2019 was precisely about that. We, in particular, in these aspects of, say, institutional and governance strength that are really quite qualitative, the methodology update was to explain more clearly how we differentiate between sovereigns in that respect. We also aim at transparency by providing regular updates to the market, and in particular on our rating announcements. So we do a lot more than announcing a few letters and a number. We publish press releases that explain in detail our assessment of the credit profile of that particular sovereign, what has changed, what has not changed, and our expectations going forward. We also publish some research reports to complement all of this. Some of the research reports are specific to particular sovereigns, some are more thematic. And to give you an example of the current situation, that is really quite troubling indeed. Already on 8th of February, so 2 weeks before Russia invaded Ukraine, we published a report addressing a number of questions about how we, as rating agency, would look at the implications, the credit implications of a potential invasion of Ukraine. So that market participants were aware of our views a priori, and then we kept monitoring developments over the course of the last, the following weeks. Since then, looking at the broadening of the crisis, the ripple effects that this conflict has around the world, we have published reports on the impact on sovereigns of the surge in food prices, which both Mrs. Mohammed and Minister from Ghana alluded to. Indeed, that is a concern for us, high inflation, giving potential rise to social risk. We also looked at, for instance, the impact of a sharp drop in remittances flow to the CIS from Russia. So these are just 2 examples, but to give you an idea that we promptly, on a really timely basis, update financial markets about our assessment. We have mentioned, and Mr. Miso mentioned ESG, and that is indeed very important. And what we, the way we have addressed the very significant, clear call from financial market participants, regulators, for, again, more transparency in this area, we have started to publish a set of ESG scores for the issuers that we rate. We've now published ESG scores for all sovereigns, all 145 sovereigns. And this scores, and that's very important to understand, what this scores convey is our assessment of the credit impacts of ESG. So it's the impact on sovereigns' ability and potentially willingness to repay debt of environmental, social, or governance questions. And that's why we really focus on the issuer level, because it does come down for us to that credit assessment. That's really the integration of ESG in credit. But that allows us to really convey our assessment about very long-term developments, including environmental risk, climate change, as well as carbon transition, as well as demographics and other aspects of social risk that are likely to develop over the very long term. Last, I would say just 2 points on our assessment of the quality of work. And I think that's, it is very good that these questions are raised. We ask ourselves these questions. We do monitor the quality of our ratings. I'll mention that in 2 ways. One is we check very regularly, and we publish the results of this analysis on an annual basis, that our ratings perform as a rank ordering system. Ratings are relative. I think everyone in the audience is aware of that. And so we check that the frequency of default is higher at low rating levels than the frequency of default at high rating levels. And that is what we find. Since 1983, sovereigns that have defaulted had a lower rating than more than 90%, really close to 95% of rated sovereigns. So that rank ordering really works. There are other ways we measure that, and we find similar answers. Another way, another check that we perform is that our ratings provide a strong signal and not noise to financial market participants. That there's really a stability in our ratings, so that when investors, asset managers see a rating change, they can be confident that it is a lasting change. And again, we find that this is the case. Focusing on sovereigns since 1999, 19% of ratings have changed. That compares to 81% of changes in market implied ratings, in the ratings that we would infer from bond yields, for instance. And we find that when these ratings did change for us, when our ratings did change, then they were reversed in only 0.4% of cases within a year. So that lasting value, that really high signal to noise ratio, we think is being achieved. I'll leave it at that. I'm very happy to take further questions in more detail, but I think I wanted to really explain maybe more clearly how we aim to achieve this transparency, consistency, forward-looking nature, and independence of view, and how we check the quality of the service that we deliver to financial markets. Thank you.
Thank you very much, Marie. Very informative, very interesting. I'll come in reverse order. That, for example, you started to publish ESG scores, and it would be very interesting if you could share with us, which I think would be very interesting. And also, for example, the last point you made about how lasting your ratings are. I mean, one can ask also the question that I raised before, and that the Minister of Finance of Ghana raised, is whether, you know, they may be too lasting. So that maybe when the country improves, does the rating respond as flexibly and quickly to the improvement, which is of course very important for the countries, particularly the low-income countries. I think it's very interesting that you mentioned that you have quantitative information in the models and there are more subjective information. Now, there was a study by Professor Stiglitz and others after the Asian crisis, which argued that the more pro-cyclical character of some of the ratings responded more to the qualitative nature of these ratings and the qualitative part of the ratings. And there is an interesting question that maybe you would like to address later, whether it would be useful to separately publish, separately, the more quantitative, objective, if you like, aspects of the ratings from these more qualitative and more subjective ratings. I think that is an interesting issue that has been raised in discussions in the UN. It was very positive that you know, you mentioned that how the coverage has increased, and I'm also very sympathetic to the point of uncertainty. I mean, it is, of course, easy to criticize any projections that you make, but it's very difficult to make projections. So any actor in the financial world will have difficulty. There is no perfect way of rating. So I think, you've made a number of very valid points. I would now like to ask our next speaker, to add their perspectives. That is Ms. Ileana Lani, Head of Rating Indices and Securitization from the important body ESMA, European Securities and Markets Authority. And I would like her to comment on these two following aspects, if she would like to. First is, of course, that since the 2008 financial crisis, the European Union has introduced new regulation on credit rating agencies. And if you could elaborate somewhat on what these new regulations are and how effective you see them. And also from your regulatory perspective, how do you ensure that credit rating agencies contribute towards stable and efficient capital markets? I think your experience is, of course, particularly valuable in the European context, but any thoughts you might have on the impact on developing countries, poorer countries, would also be very valuable. So I offer the floor now to Ms. Ileana Lani. Thank you very much.
Thank you very much. Good morning to all of you. First of all, on my behalf as well, let me say how honored I am to be invited to today's meeting and have the opportunity to discuss this very important topic from a regulator's point of view. So credit ratings have a role to play in financial markets, and at the core of this role is the information value that they have for investors. Over the last 10 years, the European Securities and Market Authority, ESMA, has been the supervisor of credit rating agencies operating in the European Union. Our starting point is that credit ratings need to be appropriately regulated and supervised in order to properly fulfill their role in financial markets. And to this end, credit rating agencies in the European Union need to adhere to a detailed regulatory framework that ensures key requirements are met. This means that all credit ratings issued in the European Union need to meet minimum standards of quality and transparency. These regulatory safeguards are important to mitigate the risks that credit ratings can pose. For example, lack of transparency on what factors have been considered as the basis for a credit rating action could lead investors to uninformed decisions. Over-reliance on credit ratings could lead to cliff effect for investors where downgrades occur. And especially in the case of sovereign ratings, the risk of pro-cyclical spillover effects exists, especially in cases where these rating actions are not clearly explained. While this is a simplification of the issues that our regulatory framework is seeking to address, it is a useful summary of some of the key concerns that were behind its initial introduction. But how our approach to addressing this concern has developed. So the first steps were taken following the 2008 financial crisis, when measures were introduced to ensure credit rating agencies were subject to regulatory and supervisory oversight, and their products met minimum standards to ensure their integrity and reliability. While this represented a significant step forward and is the foundation of our regulatory approach, the sovereign debt crisis that occurred in Europe at the start of the last decade indicated that these measures were still not sufficient to mitigate all the risks credit ratings could pose to our financial system. For this reason, a further set of measures were introduced, this time with provisions to address over-reliance on credit ratings and improve transparency and disclosure practices around sovereign credit ratings. It is within this context that our current framework is operating, and we are using the available tools to support investor protection and orderly market. But I would like to focus on two aspects that we consider to be particularly relevant for today's conversation, and many of the previous esteemed co-panelists mentioned: methodologies and, of course, sovereign ratings. So when it comes to credit rating methodologies, the approach of the European regulatory framework is to require that they are rigorous, transparent, independent, and free from interference. In practice, this requires that methodologies should take into account all factors that are considered relevant to the creditworthiness of the entity or the issuer. And at the same time, these methodologies should be disclosed and be publicly available. The goal is to ensure that the credit ratings produced by them are of high quality and the users can make their own judgments on the assumptions underpinning them. As per the requirements of independence and non-interference, while our role as regulator is to make sure that credit rating agencies are meeting the high standards expected, the regulatory framework includes provisions that prohibit ourselves as a supervisor from interfering in the content of credit ratings and methodologies. Under this approach, it is not our role as supervisor to intervene in how credit rating agencies' methodologies assess creditworthiness, and it is beyond our power to mandate that certain factors should be taken into account to a greater or lesser degree. But while we cannot interfere in methodological judgments, we do take steps to ensure credit rating agencies are as transparent as possible about the basis of their rating actions. Indeed, this is an area where we have taken actions to ensure credit rating agencies are more transparent about the relevance of factors, with ESG factors being one of the most recent examples. With regard to the sovereign ratings now, enhanced disclosure requirements for sovereign ratings are another feature of the European regulatory framework, reflecting their special place in the financial system. We should not forget that sovereign rating actions, especially downgrades, have important knock-on effects on other classes of credit ratings, as sovereign ratings act as a ceiling and limit the maximum rating that can be assigned to other ratings of a certain country. As also mentioned by Mrs. Diron, when credit rating agencies publish a sovereign rating, they also have to publish together a detailed research report that is clear and easily comprehensible. The level of detail required here is more than what is demanded for other rating classes. And at the same time, credit rating agencies cannot make any policy recommendations when announcing a sovereign rating. But beyond these more stringent disclosure requirements, our framework also looks to provide greater levels of predictability around when sovereign rating actions are published. For example, any sovereign rating action has to be published according to a calendar that is set in advance, and the dates of these publications have to be on a Friday after the close of markets in the European Union. In my view, this enhanced set of requirements on sovereign ratings have been a good step forward to addressing some of the issues that were identified during times of previous market stress. And they serve as a good example of how a regulatory framework can adjust to mitigate some of the risks that sudden or significant sovereign rating announcements can pose to the orderly function of financial markets. Of course, this is just a sample of the requirements that credit rating agencies are held to under the European regulatory framework. But when we discuss how credit ratings may evolve, it is worth reminding that these basic principles of rigorousness and independence of methodologies have been the cornerstones of our approach to reducing the risks posed by credit ratings to financial markets. If I could conclude my intervention by looking back on our most recent experience in handling crisis, I believe that the legal framework that is currently in place has put us in a better position to address current or future challenges. This is not to say that the regulatory framework does not have room for further improvement or that it is entirely future-proofed, but I considered it gave us a better chance of striking the right balance on the extent of use of credit ratings in the financial system of the European Union compared to the initial setup. And with that, I would conclude, and I hope my intervention has provided some interesting food for thought for your very, very interesting discussion. Thank you very much.
Thank you very much, Ms. Elmarie Haman, for this valuable. Sorry, I made a mistake. I'm sorry, Ms. Ileana Lani. Thank you very much for your valuable insights about how the European Union Security Regulate and Markets Authority work and what improvements it has made. I mean, you've made a number of important points that the importance of supervision. And how this has evolved since the 2008 and the Eurozone debt crisis, and also your reflections on methodologies, and that you do not regulate methodologies. I mean, I think maybe in your next intervention, you could comment on the fact whether one could consider some regulation of methodologies. Particularly in perhaps just as an example, two elements. One is, of course, the pro-cyclical nature of alleged pro-cyclical nature, which there's quite a lot of evidence of credit rating agencies, and either suggesting or regulating how that could be improved. Secondly, how these ESG factors, which you have said that you do consider, but how could they be more explicitly included in the methodology to ensure that there is the integration of these ESG criteria, which Mr. Mizuno was emphasizing. And thirdly, I think particularly maybe relevant in our discussions today is if any kind of bias in terms of downgrades, particularly of poorer countries, is sufficiently considered, and whether it could be somehow eliminated. I think these are interesting and important issues. And also, of course, any advice you could give on how to enhance the role of regulators in emerging and particularly developing countries, and give them more voice, because I'm sure that when ESMA speaks, the credit rating agencies listen more than if a regulator from a small developing country speaks, and how that could be maybe amended. Our final speaker is Ms. Elmarie Haman, who is from the Financial Sector Conduct Authority from South Africa, and great to have the voice from South Africa, together from the voice from the Finance Minister of Ghana. And I would like you to comment on these following points. First is that South Africa has some of the most developed financial markets on the financial continent. And South Africa has a regulatory framework for the work of credit rating agencies. What are the main issues that you focus on in the regulation of rating agencies? And how do you view, secondly, how do you view your role with respect to ensuring credit assessments contribute to long-term development and long-term provision of investment in South Africa? Thank you very much. We look forward to the presentations, Ms. Elmarie, and the floor is yours.
Thank you very much. I just want to say in South Africa, the Credit Rating Services Act of 2012 was promulgated in 2013, and it's supported by a set of credit rating rules which were published on 15 November 2013. The Act, together with the rules, provides for both the regulatory and supervisory requirements and is legally binding on registered credit rating agencies. Among other things, the regulatory framework specifically emphasizes the independence, objectivity, integrity, and quality of credit rating agencies and the rating process as a whole. A credit rating agency must adopt, implement, and enforce written procedures to ensure that the credit rating that the CRI publishes is based on the thorough analysis of all information known to the agency that is relevant to its analysis and in accordance with its own published rating methodology. The credit rating agency must design appropriate and sufficient procedures and reporting channels to ensure all actual or potential conflicts of interest are identified, eliminated, and managed. The rules on conflict of interest furthermore note circumstances like ownership of securities or financial instruments in the rated entity, related party relationships with the rated entity, and require disclosures and or withholding of a credit rating in those instances. Integrity of the credit rating services industry is important to the FSCA. Therefore, complete and transparent disclosure of procedures, methodologies, and assumptions relevant to arriving at the credit rating will better assist users to gain a greater understanding of what a credit rating is, the process followed, and the limitations on the use thereof. There's also a requirement that registered CRAs should adopt, publish, and adhere to a code of conduct in line with the IOSCO Code of Conduct Fundamentals for credit rating agencies. Any conflict of interest is illegal, unethical, or contrary to the credit rating agency's code of conduct. The act or rules must immediately be reported to the compliance officer or any other officer of the credit rating agency. The FSCA also has prescribed fit and proper requirements for credit rating agencies, and it includes honesty and integrity, requirements for competency requirements, operational ability, financial soundness requirements, and also financial soundness of directors and employees. The CRS Act also provides that any person that performs credit rating rating services or issue a credit rating in the Republic that is not registered CRA, or any person that makes a misleading, false, or deceptive statement or conceal any material fact or in the execution of its duties gives an auditor or compliance officer information which is false or misleading, or conceals material fact is guilty of an offence and a conviction liable to a fine or imprisonment for a period not exceeding 10 years or to both a fine or imprisonment. So we, on an annual basis, conduct on-site inspections at all the registered credit rating agencies, where we then assess their compliance with the Act and these rules. We issue a report and we make recommendations if we identify any gaps. We also have included ESG ratings into our inspections that we do. And although we don't have a specific guideline like ISMA issued on disclosures of ESG factors, the CRA regulations that we currently have includes a number of disclosure requirements relating to credit ratings. It, for example, has to disclose practices, procedures, methodologies, and models, as well as key rating assumptions it uses in its credit rating. And although, and like I said, although the FSCA has not specifically issued guidelines relating to ESG disclosures, CRAs are expected to identify ESG relevant factors, elaborate on their materiality, and also include a reference to where an explanation of how ESG factors are considered as part of the credit rating process can be found. For example, a reference to their credit rating methodology. The purpose of these requirements is to ensure sufficient level of transparency around the credit rating actions so as to enable the user of the credit rating to understand the main reasons for the credit rating, any limits or uncertainties underpinning the credit rating, as well as where further information can be found to facilitate their own due diligence. During our on-site inspections, we specifically focus on ESG factors and the disclosure thereof. And for example, during our 2020 on-site inspections, we interrogated the methodology followed to ensure that ESG factors were considered and disclosed. And in addition, we conducted interviews with senior staff of CRAs. For example, in one instance, we interviewed the global head of sustainable finance and analytical innovation, and also review the CRA's ESG roadmap. For the current financial year, we are planning to conduct a thematic review across all registered CRAs on their disclosures of ESG factors by CRAs, We intend to benchmark current practices against the ESMA guidelines on disclosure, like I said, of ESG factors to identify gaps and to recommend corrective measures. The purpose is to ensure that there is a uniform approach with a sufficient level of transparency. Thank you.
Thank you very much. That's very interesting. Interesting both the collaboration that you have with ESMA, but also how you're introducing ESG guidelines in your regulatory effort, and how you, for example, make legal conflicts of interest. And I think that is a very interesting issue. And maybe one could think about how you could expand the collaboration, which I assume you have with other African regulators, so they can learn from the valuable experience of South Africa, and how you can perhaps make closer the links with bodies like ESMA and the equivalent SEC body in the US. So I have some additional, time is a little bit short, but it's been such a rich presentation. I have some shorter questions, hoping for shorter answers, but very important, on focusing more on solutions, if I may. And I would like to start again with His Excellency Ofori Atta, Minister of Ghana, asking him how can we, and particularly your countries, engage credit rating agencies so they can create a more conducive environment that would attract more long-term investment, particularly for countries like Ghana and other developing countries. If you could do that, it's very difficult, but in about, say, 3 to 4 minutes max, that would be great. Thank you. The floor is yours.
Actually, thank you, Stephanie. I mean, truly, I think, you know, the interventions by the, you know, the intervention by Marie and Lani and co, I mean, just really in effect exhibit not only the need for them, but also the need for who watches the watchman. And also, I guess, to ask the question, what was the Sabbath meant for?
So what was the last thing you said? I didn't catch.
What is the quotation again? You know, the Sabbath was not meant for the Sabbath was meant for man, but not man and for the Sabbath, you know, because they've become, in a sense, decision makers. Because if you listen to Mazuno, essentially you could look at the world and say that we have $10 to distribute. By the very nature of the way in which all of us are non-investment or whatever grade, that means maybe a half of that can be made attributable to the place that needs the most capital. So is there a methodology or a system that would enable us hurdle that, because the statistics do not show the level of default that would lead to the supposed issues of transparency, consistency, forward-looking, and independence. And those are the rules, and then all of us know how rules can be inherently biased and not allow a certain grouping to be able to contribute to the very essence of how do we get capital around the world for development to occur. So Mazzoni was faced with having the largest pension fund in the world, and really his arms were tied. He couldn't do anything. But truly, Ms. Diron's company was doing the supposed right thing. You know, so the challenge is in that. And then if they honestly were also to do some statistical analysis to determine their impact on the distribution of capital, they might be jolted to ask questions on exactly how this thing should be effected in such a way that capital gets to the right place. Because what are we all doing? What we are doing? Yes, to protect capital, but inherently to ensure a productive world. You know, we can pretend all we want that that is the inexorable path that we should be going along. And if therefore you assess the contribution of the credit rating agencies, and it seems to consistently lead to a situation where capital is not getting to these parts of the world, then something needs to be assessed as to their relevance and for the future and for us, and not that narrow definition. So I think that becomes the issue that we are contending with, that we have to truly look at. Yeah.
You couldn't have said it clearer, Minister. I think the key issue is how can credit rating agencies and other bodies contribute to channeling more, but also more long-term money. The short-term money doesn't always help.
Yeah. Yeah. I mean, I don't think anybody wants to, come in to tell them what to do. But does the nature, given that they have now become inadvertently decision makers as to where the resources of the world can go to, they play a very, very significant role beyond, what they were meant to be. And that's my question. Was man made for the Sabbath, or the Sabbath was made for man? And we need to look at that. I mean, obviously, the EU has found it necessary to come in to ensure better regulation, so they are fallible, and a reassessment, especially this COVID period and what they did in the world, especially for Africa, whether that's a way in which we want to see the redistribution of capital. Thank you.
Thank you very much. And I think there is also a point which somebody sitting here like Jeff Sachs, I'm sure would make rightly, is, if private finance cannot deliver sufficiently and in a sufficiently stable and long-term way, then can we, do we need to rethink the development finance architecture, and should we push for greater official flows, for example, through the World Bank and the regional development banks, other mechanisms, to complement, the somewhat problematic and insufficient private flows, given the urgent needs for development and for the climate emergency. So I think that's something to think about. I think I had some questions here for the other speakers, but I think the urgency of the questions posed by the minister I would like to ask the other speakers, because they're such key actors, if they could contribute to that. I have some more specific questions if they have time, like for Hiro Mizuno. Is there the issue of cliff edge between investment grade debt and speculative grade debt? And how could that dichotomy, which is so sharp, be perhaps modified? And I think that's the main one. And for Mary Diron, there is a concern, as you know, that many countries didn't want to participate in the DSSI because of the fear of that it would lead to a credit rating downgrade, and what lessons can be learned from that experience? Not just the DESA side, but a deeper debt relief, actually. And for Liana Lani, to what extent do you think the COVID crisis has raised new regulatory issues?
Oh, yeah.
And finally, for Anne-Marie Hamann, how do you think the views of the northern regulators?
Yeah, Stephanie,
Yeah.
excuse me a second. Just 1 second. I recall some very sort of spirited discussion with Jeff and Jeff Sachs, and I was wondering whether he could give us a minute or so of that discussion.
I think that's a great idea. Yes, Jeff,
Thank
please
you.
go ahead.
Thank you very much.
Greetings to everybody. Thank you for the fantastic discussion. I think the rating system is just broken. Actually, it's analytically without foundation. Unfortunately, when a sovereign rating is made, it affects the ability of a country to borrow, but it does not address the question of whether the borrowing is for long-term infrastructure, at long-term maturities, short-term maturities, what the political framework is. In other words, it is just a blanket rating that when you look at it is based on a mechanistic and largely backward-looking, rather simplistic methodology, devoid of a development framework. And the end result is that of 82 countries that are low income or lower middle income, 79 countries are without investment grade. So literally half the world is barred. And the most recent data are shocking. The low income countries are 8% of the world's population. And in 2019, before the pandemic, most recent data, they undertook 0.4%, 1/20th of their per capita proportion of the world's investment. So they're investment poor, they're capital scarce, and they receive 1/20th of the investment per person on average in the world. This is a completely broken system. But I think the key point is that it's also without concept, because the rating agencies are not development finance institutions. They do not look at a development framework. And what they do look at is short-term credit interruption risk. But this is largely self-fulfilling. If you are sub-investment grade, you are constantly in difficulty of rolling over debt. Any event that comes, you can't roll over debt. Even if your debt to revenue or debt to GDP ratio is low, your liquidity is bound to be extremely low. So when we heard that there's a correlation of the frequency of defaults with low credit ratings, believe me, this is bicausal. This is not from the accuracy of the credit ratings as much as the effect of the credit ratings on default risk, because a sub-investment grade country cannot routinely roll over debt. So what we have is a system which is keeping half of the world's countries away from international finance. Those countries are forced into short-term borrowing, high interest rates, and great risk of defaults because of the short-term tenor. They're constantly amortizing debt, which no government does when it is creditworthy. It just rolls over debt. And so this is a broken system, but I want to emphasize that it's broken analytically. It doesn't make sense, the ratings, because it's not in a development framework. And we need a development framework in which a country like Ghana, like the ministers, is developing over a period of 20 to 40 years, is borrowing on tenors of 20 to 40 years, is not paying crushing interest rates to do that. And lo and behold, if Ghana were borrowing on 30-year maturities at the same rates as US Treasury bonds, there would be no credit risk whatsoever. There would just be development. But we have made a system where we painted ourselves into a corner in which there can't be development because the minister has to go out and borrow short-term at crushingly high interest rates. And then when there are credit events like a Ukraine war, or like a 2008 financial crisis, or like a 1997 Asian financial crisis, there will be an interruption of the capacity of Ghana to amortize the debts, and then it will be a default, and then it will go into the data showing that low credit ratings are correlated with defaults. So let me stop there, Stephanie. Sorry to carry on, but I want to emphasize that the system is broken conceptually, not just operationally, but conceptually at the core. We're not measuring the right things.
I thank you very much, Jeff. I think it's a very important point about the structure of the whole system. But I make this parallel point that I made before about, first we must try and fix the system. If it doesn't work, fixing the system enough, we have to also argue for more public resources internationally. But I would like, so I'm a little bit squeezed for time because Mr. Mohadin has to speak and leave. So he has to speak in, I'm sorry about this, 7 minutes. But I would like to ask Hero maybe to comment on what Jeff has said and what other questions.
Well, let me quickly comment on that. I mean, I'm not saying like a credit rating agency can, they play bigger or more effective role in solving in these issues. But I just wanted to point out, credit rating agency is, as that name really suggests explicitly, they are agent. Okay, who are principals? Principals are banks and asset owners and asset managers. And when I was running a GPIF, I tried to engage with the credit rating agency, trying to find out engage with them to really affect the way they rate this, the ratings. They make a rating to allow the GPIF to make more investment into development countries. But how many other credit, asset owner, asset manager really engage with them? Because they are agent. They don't have a will. They don't have a directional intention to solve the problem. But asset owners, asset managers, banks, they are principals. They are the ones who drive the change. So I think we should keep asking credit rating agencies to do better job. But at the same time, we really need to hold the principals accountable for this systemic the issue of not solving the this capital allocation issue into the sustainable project and developing countries.
I think that is a really key point about how through regulation or other means you could influence what banks and the large institutional investors do, and also rethink the role of credit rating agencies and their regulation. And there is also more radical ideas about possibly creating some kind of public or independent rating agency, particularly for these long-term factors. Because as Jeff said, I mean, the problem is systemic. The cyclicality of the flow, shortness of high cost is something that keeps repeating.
Yeah, but Stephanie, one point I try to make is the asset owners, asset managers, they are not regulated, not invested into the non-investment grade debt. So it's just a rating, and it doesn't the handcuff investor to do that, but system itself kind of created systemic handcuff to the asset owners to make the investment in developing countries. So that's a systemic problem, but not just but the people's will can overcome it if everybody works works together.
Of course, it's human created. It's not a force of nature sometimes some conservative analysts say. I mean, could one think, and this is quite radical, that a certain proportion of big investment funds or indeed bank lending should go to developing countries or should go to green investment? I mean, you know, is that so radical really, or does it make sense if you follow your diagnosis and that of Jeff? You know, so I think either the system is adapted or we have to think about more radical measures. So we have now 3 or 4 minutes, if you don't mind. Who else would like to jump in with proposals? Yes, please, go ahead.
Thank you. If I could add to this discussion on reliance on credit ratings and share our experience in Europe. So following the financial crisis, we tried to implement in the European legislation certain provisions that could remove, let's say, reduce reliance on external credit ratings. One major outcome of the latest revision of the European legislation, on CRA3 we call it, was the introduction of a requirement that financial institutions should carry out their own credit quality assessments and should not rely solely or, let's say, mechanistically on credit ratings for assessment of the creditworthiness of an entity or a financial instrument. Admittedly, although there have been steps, and also following the COVID crisis, this is still an area we're still working on, and we try to improve.
I think that's very important. We have a very brief time. Would you like to add some things?
I mean, just really to. Yeah, thank you. Just to summarize it, I think I've heard a number of really different questions and all relevant. I think it's important to separate them. What I would say is that we're very really willing to engage more. There is to be a forum being set up to look for potential solutions, very willing to engage, with the caveat which Ms. Lani reminded us, that we do not give advice to investors. So we really stay at that. What I've heard is procyclicality of ratings. I think the statistics that provided about reversals of ratings compared to reversals of market signals, much lower reversal rating, is really our check. Indeed, it is important for us to check that this is not a pitfall that we fall into, and we are quite confident that so far at least we've avoided that. To the circularity, between ratings and cost of financing, and that having an impact to the ratings. Well, here we do look at the range of financing sources and financing needs that each sovereigns have, and we do see differences. So the average debt maturity for a sovereign is around 6.5 years. For South Africa, for instance, the average maturity of debt is 10 years or more. So South Africa really has really raised financing from different sources, including at very long maturity, and we do take that into account. The point about then how ratings are used, as I said, this is something that we would listen to, but not necessarily engage in, as I'm not providing advice, since that would go counter to really our independence. And last, I would say we've had a really very beneficial experience of the work around ESG. We've done that listening to different parties, including through our participation in the UN PRI, the Principle for Responsible Investments. Moody's has been a signatory for since 2019. And that has been really a very good forum to listen to market needs, listen to what other institutions were doing in that area, and how we could enhance, maybe fill a gap in some way, and as well as enhance the transparency of what we do.
Thank you very much. And the timing is perfect now for me to ask Mr. Mahmoud Mohyeddin, UN Secretary General Special Envoy on Financing the 2030 Agenda, who has served in many roles, both from senior policymaker at a national level to international institutional leadership. to close this panel and hear your thoughts based on the discussion, and particularly on the issue of how should the international financial system address the gaps identified and the problems and move forward to create the right information, institutions, and incentives to support the long-term lending that developing countries so desperately need. Thank you very much. Mahmoud, the floor is yours.
Right. Thank you so much, Stephanie. I hope that you can hear me well. You did a wonderful job in summarizing the very important comments by the distinguished participants today. And so that will get me more in a kind of a forward-looking approach on what could be expected from this very important panel dealing with a very critical and sensitive topic. We have been really waiting for such rich discussion for quite some time. And we say we, the group that had been supporting the Secretary General and the Prime Ministers of Canada and Jamaica for their Finance for Development initiative. And I'm saying that because in the many discussions we had with ministers, like our Honorable Minister today, Governor of Central Banks, they have been really putting lists and lists of requirements and expectations from rating agencies in times of crisis. I know that they are constrained, they have jobs to do, but I think the discussion today confirmed what we're speaking about almost for 2 years now. One is related to methodology and how this methodology should be more dynamic, factoring in the new changes, properly explained. Second is related to transparency and how this methodology is being applied, because there is a perception, and the only way to deal with perception is to share more information, that there could be discrepancy based on your location, whether you are in Africa or in Europe. If you have the same credentials, if you have the same risk profile, you might be treated very much differently. Third, in issues related to the required long-term perspective, as mentioned today by Professor Sachs and by the Honorable Minister, there have been calls for long-term SDG-aligned social and environmental indicators to be inserted in the methodology and to be applied adequately. And then there is an issue. Definitely, it may not really be the responsibility of the rating agencies, but many of the entities that are there in helping the capacity development for developing countries, that we really need adequate counterparts. I worked in this kind of business before when I was in government as an advisor, senior advisor, and then as a minister of investment back home in Egypt. And I know that there could be a lot of work that could be conducted by many entities, of course, without really them being suffering from any kind of conflict of interest to enhance the capacity. So this is about what we have been talking about since March, April 2020 until perhaps yesterday. And I'd like to thank my good UN DESA colleagues for bringing us together. And I'd like to thank you as well, Stephanie, for the many important pieces of work on background information that you provided to the teams internally. But we're in a completely different world today, unfortunately worse than what we were. The pandemic is not over yet. Some people are assuming that it is, but it is not. Second, we are confronted by tough crises, reminding us of the problems of 2007, 2008, the 3 Fs of fuel, food, and financial challenges and crises. So unfortunately, it's more likely than not that countries suffering from the challenges and distress will be more in the increase. And at the same time, accuracy and adequacy of data and information coming from the rating agency, guiding countries as issuers and investors as lenders are going to be much more required going forward. An issue that was not raised, it's not just about the sovereign side, it's basically about the rating of the IFIs as well. Those who enjoy triple A rating for good reasons. But I think many of these IFIs were reluctant to do more in fear of losing their investment grade. So I think some sort of another communication would be required for the IFIs with the rating agencies, especially if we are dealing with some of these IFIs as the last resort and the firefighters. Then my last point is basically about this issue that was raised in different ways about ESG, climate, and whether we know really what we're talking about. Let's all be humble here, because all of us are new into this business. Rating agencies were not really very much involved in ESG rating until very recently, while one would respect the kind of accumulation of knowledge and expertise that they had for many years in conventional rating, but factoring in ESG and climate-related disclosure is new for all of us. I'm saying that because there are great complaints about greenwashing. There are issues of concern about almost $3 trillion worth of assets are now managed in more than 2,900 ESG funds that require adequate rating for them. I'm not moving from the sovereign to the corporate, but there are lessons from the corporate and rating and these funds rating that could deal with serious implications of countries adhering to the rules of the Paris Agreement and the disclosure that is required and their indices. We're going to be seeing that kind of work from ESG in companies to the implications of climate change and Paris Agreement to countries. So you may have seen, like me, that piece that came out recently from the Financial Times, summarizing the work of MIT Sloan School of Management about the problems facing rating of ESG performance of companies, funds, and portfolios, which is the primary purpose of ESG rating, that it is very difficult to evaluate because of lack of standardization. This is really a very critical issue because here we need really, when we talk about transparency, we need to be transparent about what we're talking about. Second, the ESG rating divergence decreased companies' incentives to improve their ESG performance. This is very likely as well to be a problem for countries if we are going to be dealing with issues related to their banking system, requirements for disclosure, and the sovereign disclosure, and the sovereign bonds issued claiming that they are green enough for the investors. So these are big issues of concern, growing as we speak. And I think if it is anything, based on the many questions raised today, it's I encourage our colleagues from UN system, including, of course, DESA, to continue the discussion. I agree there are issues that are requiring now this kind of important dialogue, but searching for answers before it is too late. Thank you so much.
Thank you very much. I think that was an excellent summary of a really good discussion. But I think, we have, the UN has and other bodies have to think about how they go over from this interesting identification of issues, moving towards action, which is said very urgent. So I don't know, maybe it's a working group but I think this has been very, very helpful discussion as a basis for further more detailed.
Stephanie, I'm sorry, this is really out of protocol, but I really would like to emphasize that we should be very, very clear that the very nature of credit rating agencies have made them decision makers as to how funds will flow around the globe. So if we talk about Africa needing about 1.3 trillion of SDG financing to meet the goals, 4.3 trillion for infrastructure, 3 trillion for COP related issues, we're talking about 8.6 trillion, in which people like Nuzoni and serious asset managers cannot, by the very nature of the existence of credit rating and what happens, enable those funds to flow into Africa. So we come to a self-fulfilling prophecy, which says that this continent that is going to be have the quarter of the world's population in a few years is not because of the very nature of credit rating enable the resources of which are extensive to come into this continent. So it's not really just an acerbic, quiet look at what they represent, but they represent something that will not allow an effective distribution of resources for global development, and to accept the issue of the common humanity as to how to improve our world. So I think it is a very serious thing. And Mahmoud, I really thank you for bringing this up. But we need a sense of urgency about it, because they are redrawing the economic map of the world. Thank you.
Thank you very much. I mean, I think you're sort of implying that we should, because we always start looking at the financial sector and its different actors. And you're right that the credit rating agencies are very important and are relatively unregulated. But I think we need to start from the needs, the demands from developing and countries and generally globally. And then we can look at the financial system as a whole and how it can best contribute to meeting the needs. I see Jeff would like to say something, but I know that we're running a little bit late, and I should pass on to Shari Spiegel, who will chair the next session. But because Jeff will have something so interesting to say, I would like him to ask him if he can say that in 1 minute.
I just wanted to emphasize that if we look at the issue correctly as a long-term development issue, all of the risk factors also change. Even borrowing 100% of GDP is no problem for a developing country on a 40-year loan at 2 or 3%. But borrowing that amount without investment grade on a 5 or 7-year loan is, of course, preposterous and will lead to a crash. So the problem is conceptual. The credit rating is not in the framework of development. It is just a credit rating, and it actually pushes us to the bad equilibrium. That's the main point. We need a credit rating system, not that ignores risks, but puts risks in the proper framework so that we get to the positive development outcome, not to the minimum outcome. That's where the minister finds himself stuck right now. And that's the main point. It's not to say risks shouldn't be analyzed, but the way that it is done now creates a self-fulfilling barrier for poor countries. Moody's should, by the way, check your own system scores poor countries lower numerically, automatically, just for being poor. This is impossible in our world today, and it's analytically broken.
I think that's very valuable insight. That's a central issue. Thank you so much for raising it. And thanks for such a nice end to our panel. Thank you, Jeff. I now pass the floor to the chair of the next session, my dear friend Shari, and thank you all of you for your valuable contribution.
Great, thank you, Stephanie, and thank you everybody for your participation and the really very interesting panel, the first panel we had, that really raised a number of important questions. I'm Shari Spiegel from the Financing for Sustainable Development Office of UN DESA, and I'm going to chair the next panel. The next panel is meant to cover sustainability and stability issues, though of course many of these issues were just covered in the previous panel because they're very interlinked, so it's very, very hard to separate them. I want to start maybe taking off from Jeff's last comment, because the issue of long-term investment when it's well used and invested in productivity and productive and sustainable investments can really stimulate growth and therefore reduce debt overhangs in the long term. And that's, in fact, we just in April, we will be publishing the Financing for Sustainable Development report, a report that we put together along with the entire international system, including the IMF, World Bank, and the entire UN system, as well as the OECD secretariats at the South Center. So more than 60 agencies work together. That is actually one of the main points of that report. And we did a study in preparation for that report, working with Ugo Panizza, on doing exactly what Professor Sachs just mentioned, looking at what would have happened if developing countries had been able to borrow at US interest rates, and what would their debt sustainability look like now. And it would be much improved. And in fact, and that's without even including the aspect of additional investment. So, and the additional impact from the investment. So this really is an issue that it's a bigger question. And this idea that it's really linked to the question of long-term investment and thinking on a very long-term time horizon, which is difficult when we start looking at capital markets because they think on very short-term time horizons. And so how does one bridge this gap between short-term risks and long-term development is one of the crucial questions. But this panel, actually, I'm just sort of moving from the last discussion, and I hope we can bring that into this second panel's discussion as well. We also have quite an excellent panel. So we have, in terms of, we were just talking about issues from Africa. We also have similar, really complicated and challenging issues, particularly for small island developing states. And so we will go very soon to our first speaker, the Minister of Finance from Trinidad and Tobago. But just to note that we will also have S&P, a second, one of the really big three rating agencies. A colleague from Aviva, the insurance company, a long-term investor, and the EU Systemic Risk Board will also discuss, because we're looking at risk issues now, as well as another academic to give some ideas. So I'm going to start with our first panelist, His Excellency Mr. Brian Manning, the Minister of Finance from Trinidad and Tobago, who also has had experience as a business analyst and investment banker, as well as at the IADB, so really brings a very broad perspective. And for you, His Excellency Mr. Manning, could you please talk from your perspective? Small islands such as Trinidad and Tobago face biggest risks from climate change, and these risks can translate into high borrowing costs for sovereigns. How do you think credit ratings should account for your country's longer-term prospects, including exposure to climate risk? And could you share with us your country's experience with regard to the financial impacts from the pandemic and your government's ability to borrow, and what role credit ratings have played in the financial planning of your country? So over to you, His Excellency.
Hello, good morning, everyone. Thank you so much for inviting me to this most auspicious forum, and I greatly appreciate the opportunity to contribute. Trinidad and Tobago, it's really, we are very fortunate that we are we have an energy economy. Now, of course, there's a lot of positives that come with that, but also negatives. Because of the establishment of our Heritage and Stabilization Fund, Trinidad and Tobago has been able to establish economic buffers to some of the factors that would heavily damage other economies. But also some of our neighbors and our friends in CARICOM are not that fortunate. And many small island states are especially vulnerable to economic disaster and to other issues that would make things incredibly difficult. And as some of the panelists have said earlier, as things become more and more difficult, the ability to finance your way out of your difficulty becomes more and more difficult also, because of course you start getting higher interest rates, so that you pile on more and more debt, and then that debt becomes more and more difficult to overcome or to repay, and it does not benefit many of our developing countries. In fact, many of our CARICOM neighbors have said that they're very much interested in debt forgiveness, because attempting to borrow their way out of the situation that they're in has proven to be very difficult, and in some cases they believe impossible. So the credit rating agencies, we believe, play an important role in establishing the cost of capital and in rating in rating different aspects of our economy and our ability to repay our debts. But when it comes to the ESG, we believe that there should be a closer look at individual aspects of the ESG, ES and G, together with assessment of credit risk to make things clearer as in terms of which country is an investment grade country and which countries are not an investment grade country. As I said earlier, Trinidad and Tobago is an energy economy, so we produce oil and gas. But the revenues we have generated from that industry has strengthened our position and has made us an investment grade country. But also it increases our carbon footprint. So does that mean that we are going to be downgraded because we are an energy economy? That's something that we have to look at. Do these rules apply to everyone equally across the board? Or is it that certain economies like ours are going to be penalized if we decide to add an aspect of the environment and environmental change to hydrocarbon producing economies like Trinidad and Tobago? So of course, in our interest, that's very much a concern. At the same time, while we think of ourselves, we also think of our CARICOM neighbors, small island states that do not have energy economies, that have great difficulty of digging themselves out of economic holes. I think of the recent hurricane in the Bahamas, also the way the pandemic has also affected our neighbors in Barbados and other CARICOM neighbors. The economy becomes very difficult. And unfortunately, several of these economies are tourist or tourism-based economies. So of course, during the pandemic, their economies or ability to generate revenues fell to almost nothing because there was no travel. Now, they've had a period where their revenues have been severely impaired, and now they are attempting to borrow money so that they can invest in terms of development, but their ability to repay those debts have been severely impacted and makes things very difficult for small island states to really invest their way out of a poor economic situation. We believe that the credit rating agencies, as I said earlier, are extremely important. They are an impartial provider of a score that allows us to access the international markets, but caution must be taken in terms of how it is we decide to rate different types of economies. Our oil and gas revenues allowed us to really weather the pandemic. We were able to access our stabilization fund. We used some of that funding to really provide payments to some of the unemployed. We provided services, we provided food hampers. We did all that we could to really protect some of the most vulnerable people within our economy. But many of our CARICOM neighbors are not that fortunate. And on top of having those challenges, they shouldn't also have the challenge of having to repay high debt loans at the same time. That isn't something that is helpful to many of the small island states. And the small island states are the ones, unfortunately, that are going to be most vulnerable to environmental changes and the impact of climate change. So I ask that the credit rating agencies, yes, we believe that you play an important role in the economies, in evaluating the economies of the world, but care must be taken in terms of how these economies are evaluated going forward, especially if you want to include an ESG aspect. And also we have to think of ways where we can lend a helping hand to some of the smaller developing economies that do not have the benefit of a natural resource or other types of revenue generation that can weather these difficult economic times. Thank you so much.
Thank you so much, Your Excellency. You really raised quite a few important questions. The impact of climate, et cetera, particularly on small island developing states, and the challenges of thinking about how does one evaluate a long-term rating, both for energy producers, how does one think when you think of the very long term, what does that mean, and what does that impact the rating, and the same for countries that will be impacted by climate risks, et cetera. And really highlighting the issue that this is really, we're thinking systemically. We need to think systemically across the board, because there's the markets, there's what happens when countries become over-indebted, how does one resolve those crises, what mechanisms do we have in place to address debt when it becomes a crisis, as opposed to beforehand trying to encourage investment. So thank you so much. Our next speaker we're going to go to now is to the second rating agency who's with us today, to S&P Global, to Ms. Alexandra Dmitrievich, who is the Managing Director and the Global Head of Research of Sustainable Finance and Innovation for S&P Global. And as mentioned, this panel is really thinking about both sustainability and stability. And Stephanie Griffith-Jones in the earlier panel already came up this question of pro-cyclicality of ratings. The economic literature has shown that there's some pro-cyclicality. And as Stephanie mentioned, there's even research that shows that judgment is in some ways the more pro-cyclical part of ratings. We also know that markets are pro-cyclical on their own, in large part because of the short-term nature of markets. And theoretically, a ratings would be long-term and could actually help smooth out some of that pro-cyclicality. And so over to you, Mrs. Dmitrievich, to give S&P's perspective on stability and pro-cyclicality and any other issues from this morning's session that you'd like to address. So over to you, the floor is yours.
Yes, thank you very much. Thank you for the invitation to be here today. We very much welcome this inclusive dialogue fostered by the United Nations, and it's a privilege to participate in this distinguished high-level meeting today. My name is Alexandra Dmitrievich. I'm the Global Head of Analytical Research and Development at S&P Global Rating, and in this role, I manage S&P Global Ratings Research, Sustainable Finance, and Analytical Innovations teams. The topic raised today are extremely important for us, and so I'd like to share with you our approach on 2 points. One is indeed the topic of procyclicality, which was discussed a number of times during the previous panel, but also very much how we incorporate these longer-term risks into our ratings. So this question of procyclicality arises whenever there are changing credit conditions. And that's a good opportunity to really understand or remind of the role of credit ratings in taking into account the market development. The first point I'd like to make is that credit ratings are not point-in-time assessment, and they are not designed to be static. Rather, to effectively serve their purpose as forward-looking opinions, ratings take into account on an ongoing basis all the relevant changes in the economic environment, as well as the other events that could impact on ratings. And we are required by regulation to change ratings when our assessment of credit risk changes in line with our published methodology. So rating analysts cannot choose to ignore changes that affect creditworthiness because of the potential effect that the downgrade may have. Actually, ignoring these changes, delaying or not taking a credit action based on its potential effect is in fact prohibited by the IASCO Code of Conduct for Credit Rating Agency. This code was written by securities regulators to ensure that credit ratings remain independent and free from political and economic pressure and conflict of interest. So really, it's important that the production of sovereign credit rating, like all other credit rating, is supervised by security regulators around the world in compliance with the national and regional laws. But actually, it's precisely because ratings evolve over time to reflect changes to the market or to issuer that they are seen to be relevant for market participants. And as discussed in the previous panel, they are actually far less volatile than the market, own market indicators during periods of stress. And it's also important to stress as well that the same economic stress can have a different impact on our credit ratings, or including at the sovereign level. By definition, during periods of economic and financial stress, issuers with comparatively lower ratings are expected to experience higher level of downgrades and in some cases default than those with relatively higher rated entities. And this is because, by definition, lower ratings indicate greater vulnerability to changes in economic and financial conditions, and as well less resilience and flexibility to cope with the shocks. But my important points here on this topic of procyclicality, the first point is that we have long supported the global efforts to reduce any mechanistic reliance on credit ratings in the financial system. And finally, as has been discussed as well, credit ratings are just one of many factors that investors consider when deciding how to invest. And each market participant determines, based on their own needs and objective, the relative use and weight of credit rating alongside other factors, including ESG consideration. So now let me move to the second very important question here on the impact of long-term risks, how we incorporate them into credit ratings. So long-term risks, such as environment or social risks, can influence credit ratings where we believe that they are material and we have sufficient visibility to include in our credit rating analysis. In the case of sovereign ratings, ESG factors have the potential to influence our credit analysis in multiple ways. Taking environmental related factors to start with, such as physical risk or climate transition risks, the impact can depend on a number of factors, such as, for instance, the exposure to extreme weather exacerbated by the size of the economy. Transition risks, on the other hand, include the impact of energy transition on external accounts on economic prospect. And all this can vary significantly depending on the geographical location and level of economic development. But beyond exposure, and that's really important, the policy choices and the implementation of climate resilience, adaptation, mitigation can have a significant impact on how these risks unfold, and therefore how they might impact on creditworthiness. ESG has the S factors, so social factor may impact sovereign ratings. They include, for instance, the cohesiveness of civil society, social inclusion, the capacity of political institutions to respond to societal priorities. On the governance side, this may include transparency and reporting, accountability, quality of information disclosure, policy-making tools, and effectiveness. I can give you a few numbers here. In 2020 and 2021, we had 57 sovereign that had at least one ESG factor identified as a key driver for a rating action. Health and safety factors underpinned by the pandemic were by far the most commonly cited factors, but governance factors have also driven some positive rating actions on sovereigns. And beyond sovereigns, we've had thousands of rating actions related to ESG. We have also rolled out ESG credit indicators recently. We started just at the end of last year in order to provide additional disclosure on the influence of ESG factors on the various components of our analysis. We're using an alphanumerical scale. So far, we've rolled out these ESG credit indicators on around 6,000 corporate and financial institutions globally. And we plan to roll out these indicators for sovereign credit ratings later this year. So it's one point here that we mentioned a lot, that this is a new area. There are lots of changes in the direction and the visibility of ESG factors. As we get enhanced risk-based disclosure, advancement in scientific knowledge, new public policies such as carbon taxes, this can increase the visibility and likelihood that this certain environmental issue become material, and as such, the influence of ESG rating factors, credit factors, may change over time as visibility and materiality increases. One important point is that integrating ESG factors in credit rating is fundamentally different from providing ESG ratings. It was discussed a bit in the panel earlier. So credit ratings, as we discussed, are forward-looking opinion of an issuer's overall creditworthiness. They do not measure an issuer's ESG merits, but only consider those ESG factors that are deemed relevant and material for their credit risk profile. So to answer the market's demand for more insight on an entity's ESG merit, we've rolled out new product and tool to provide high quality insight on sustainability questions, which are separate from our credit ratings. These products include, for instance, our ESG evaluation, which is designed to assess the ESG profile of an issuer and its preparedness to meet sustainability-related risks and opportunities. Let me finish here by a last point, which is really to underline S&P Global's commitment to ESG. We've worked on ESG for issues for many years. We've invested heavily to develop our ESG capabilities and to enable us to produce and integrate more ESG data. We have a team of 60 sustainable finance experts embedded within the ratings team. And at the broader S&P Global level, we've developed our capabilities through a number of acquisitions. But as Mr. Mahmoud said rightly, we need to be humble and continue to progress together. There's no doubt that some of these ESG factors, particularly climate-related risks, are complex and hard to quantify, and historical data is not a guide to analyze many of them. And therefore, we actively engage in the policy debate on sustainable finance and partner with a range of stakeholders to drive innovation and integrate sustainability into financial markets. And I'll conclude with an example of that. S&P Global's as leadership in the context of the G7 Impact Task Force last year. This group has developed recommendations to measure impact investment, taking special account of emerging markets to scale up financing. And the final report of this group highlighted how the entire financial system must be mobilized to build the necessary financing channel on impact in pursuit of the SDGs. And I will stop here for my initial remarks.
Great, thank you so much for your comments. I think that the first point, I'll just go through a couple and not in the same order. In terms of indicators for ESG, we're very much looking forward to your publication of the indicators you're using later this year. And as you pointed out, there are two different aspects. One is the impact of risks on a sovereign and in issuers' credit risk, and the other is the impact of that of the issuer on the ESG impacts to the globally and on the SDGs. That the second, of course, is more important and more relevant in a sense when we think about corporate issuers than sovereigns, what their corporate issuance is going to be on environmental, social, and governance factors. There is a lot of work going on there separately. I'm glad you mentioned that you are working on and that you have reporting of sustainability indicators as well as sustainability ratings. And there's a lot of work going on trying to standardize corporate reporting. How does one, IFRS accounting standards are trying to bring together, because there's so many different standards, so many different reporting mechanisms and risk of greenwashing going on. So there's a lot of work there, and maybe we can have another discussion on that at a later time. And then there are the issues again on the risks of ESG on the sovereign, the cost of borrowing for corporates, and particularly in this case of our discussion today on the cost of borrowing for sovereigns. And the second issue that's the mirror side of this, which is what Professor Sachs was bringing up, was a really challenging question of, okay, so we're penalizing countries, rightly perhaps, for the risks that they will be facing because it does reduce their credit quality. But then are there ways to reward them for the asset side? So when there's investment in productivity, and particularly in sustainable productivity and resilience to some of those factors, how does one bring those into the rating process? And that's challenging because it's in the future, as all ratings are thinking in the future, but something that to really consider, I think, as we move forward, if we want to have a model of that really brings in this impact of what does it mean for long-term rating for development purposes. The second side that I'm also really interested in, and maybe we can go into some of these questions in the second part, is, is with the changes in technology, how that can be used to better incorporate some of this thinking. And that's really maybe a good time to go to introduce our next speaker, who is Mr. Francesco Mazzaferro, the head of the European Systemic Risk Board, who has been working at the European Commission. He actually worked on the introduction of the euro in 1999, and to really talk on stability issues. And questions for you are, one challenge for developing countries is the short-term nature of capital markets, which we've been discussing, and the impact of market volatility on government finances. And do you see ratings actually impacting market volatility, or just market volatility being incorporated into ratings? Does it go two ways, or just one way? And the second would be, how could credit ratings agencies help to alleviate some of these risks through, and what innovations and changes, if necessary, are there any necessary? And if necessary, could help promote stable and sustainable finance? So over to you, Mr. Mazzaferro.
Thank you very much, Sherry, and thank you very much for two reasons. First, because you invited me. The second, because you made me the head of the SRB Secretariat. The head of the SRB Secretariat is Christine Lagarde. I am the head of the Secretariat of the SRB, but I'm nevertheless very happy to be here with you. Our rating possible source of systemic risk, because at the very end, this is the question we have been asking us several times. We are a body which is effective there to try to prevent and mitigating systemic risk. And the answer is, under certain circumstances, yes. But on the other hand, credit rating agencies can also be part of the solution. So to a certain extent, during the around 10 years of existence of our board, we have been confronted with three, so to speak, episodes, three different situations concerning credit rating agencies. So the first one was, as also mentioned by my colleague of ESMA, at the beginning of our own existence, we were created in parallel to ESMA. The fact that we were under the shock of how poor credit rating agencies had performed in the great financial crisis. And of course, there was this need to introduce regulation. There was this regulation which has been passed in 2013 to try to reduce the mechanistic reliance, also asking financial market participants to make their own assessment independent of credit rating agencies. I don't know whether this has been sufficient or not. It's been certainly an attempt. Then there has been a second episode, which has been basically been triggered by the COVID crisis. But the COVID crisis and the phenomenal collapse of GDP in our economies. At that time, we were extremely worried of something which in fact did not happen. So we were afraid that there would have been mass downgrading of basically of non-financial corporations, that there would have been a massive problem of fallen angels, so of basically important corporations which would lose their nature of investment grade companies, that this would have been impacting in particular investment funds and pension funds, and that this would have been also to a certain extent, of course, impacting the financial sector. We ran at that time a stress test. All of this is public, it's been published, to try to understand what would have been the implication of this. So if the credit rating agency had been moving procyclically and simultaneously, looking at the situation, the real numbers taken from supervisory data, the possible damage would have been around 150 billion in the European Union, which is not a small number. But This did not happen. Did not happen also because we have been talking a lot to credit rating agencies. We have been trying to explain what were our concerns. We saw also to a certain extent that there were some understanding of these concerns. So we were basically in the months of April, May of 2020, in the time in which the economy has just been hit, the people were dying, the hospitals were in a dire situation. Nevertheless, even if this not happened, we have been reflecting on whether the issue of procyclicality should not be looked at more structurally. And let me quote a document which is also made public, which is a document, is a letter which we sent to the European Commission, which is basically the institution which is making legislation in the European Union, and also to our friends and colleagues of ESMA, where we in particular made a reference to the idea that CRA rates should be conceived through the cycle. So that basically it would be needed to assuage the so to speak, the solvency and the resilience of, here it was mainly financial institutions, but to a certain extent, this could be also broadened to sovereigns through the cycle, trying in this way to look all of this in an economic and a macroeconomic, macrofinancial context, exactly in order to avoid undue volatility. We also refer to the fact that there should be transparency on the time horizon of any probability of default. We also made the reference to the fact that there should be also clear reference to which extent loss given defaults are taken into account by CRAs in the rating. Then, of course, we also asked that the credit rating agency would take account, and I think they did, of the extraordinary public support which was taken by the governments. Of course, this was something which, to a certain extent, made a difference. So we were afraid of something which did not happen, and one of the reasons why it did not happen was because the fiscal response, the monetary policy and fiscal response, of course, created an environment which protected the economic sector, and to a certain extent avoided a cataclysmatic event. Having said that, it might have happened. It might have happened. So we have been looking at what the numbers were, and the issue of procyclicality and the issue of fallen angels is something which should not be underestimated. And as we are speaking in these days, we should also say that the war which is returned to Europe will have impacts for everybody in the world. I'm thinking of food prices. I'm thinking of metal prices. I'm thinking of energy prices. This is happening at the same time in which there is a tightening of interest rates, and at the same time in which there are movements of the exchange rates. So we should, to a certain extent, prepare ourselves and fasten the seat belts, because we should not only speak about the past and assess the past. We should also consider the future. And then there was a third moment in which we have been working on credit rating agencies, and this is a moment in which we have been looking at credit rating agencies as part of the solution, so not only as part of a problem. And this has to do with the fact that we are very, very unsatisfied with the fact that markets are not pricing climate risk. In reality, climate risk is not priced. We also see that disclosure is not sufficient. The single supervisory mechanism of the European Union, which is the supervisor of the large banks, has just published a report in which it says that there is not a single bank in Europe, not one, which is satisfactory in terms of disclosure of the actions and the risks to which they are confronted in view of climate change. Then basically the hope is that part of the work will be done by credit rating agencies. So it's necessary that at a certain time the corporations which are denying reality or those which are trying to postpone actions feel the pressure of credit rating agencies. And to a certain extent, we have been speaking until now in negative terms about downgrading, but downgrading can be also positive, because at a certain time, downgrading can create pressure, can create fear. And to a certain extent, this is also necessary if we want that difficult decisions are taken. So, summing up, credit rating agencies are on both sides of if you want, of the balance, in the sense that they can be a source of procyclicality. On the other hand, we have also seen episodes in which they have been acting very reasonably, and finally, they might be also part of the solution. Thank you.
Great, thank you so much for those very helpful and interesting comments that I'm sure everyone has learned a lot from. I want to pull out a few of your points. The first is thinking about the risks going forward. You mentioned that one of the reasons that one of the positives during the height of the COVID crisis up till now has been that there was a conversation that you talked with the CRA, the credit rating agencies, and the importance of taking public support into account. And so I think one of the issues is perhaps to think through how that translates to sovereigns, and particularly for sovereign issuers that may not have as much access or as much conversation, let's say, with some of the rating agencies. And does this really call for a way to think through how to have more consistent and systematic discussions between issuers, particularly sovereign issuers, and rating agencies? So I think that's one thing to think about, because similarly, when DSSI happened, I think that in the end, no countries, I don't know, were actually downgraded because of entering DSSI, the Debt Sustainability Suspension Initiative of the G20, but some countries were afraid to join DSSI because of fears of downgrade. And so how does one sort of overcome some of those issues? Because DSSI, like public support, was actually going to improve the credit quality of the issuers in the long run. The second set of issues that I think you brought up, which really are going to lead to our next speaker, are the questions of thinking long-term, thinking about ratings through a cycle. What is the time horizon of a probability of default? And because, of course, if we think through a cycle, then certainly some shocks may still lead to a downgrade, but in general, you wouldn't see procyclicality because the rating would actually incorporate from the start risks that would happen when there's an economic slowdown. And so it really underscores the importance of thinking long-term, and how does one sort of go from a short-term outlook of 2 to 3 years to thinking longer term of how does a credit survive? Because as Professor Sachs mentioned, some of the issues are that the short-term issues may be liquidity issues, not solvency issues. And yet, if the markets really believe there were liquidity issues, then someone may be willing to lend, especially in situations like the most recently when there's a lot of global liquidity, just not liquidity going to some developing countries. So our next speaker is Mr. David Nowakowski, a senior strategist at Aviva Investors. David has worked in a lot of different areas. So right now he's working for it's interesting, a long-term investor insurance company, but in the past has worked at several different, different asset managers, including, I will say that in the 1990s, in the mid-1990s, David and I worked together at Lazard Asset Management. And so David, we're really interested in the one question was just thinking through what are the most relevant ways credit rating agencies can actually contribute to sustainable finance, but really looking at it from your perspective as a long-term investor and thinking there, one question that would be, I think, really helpful for people is how much do you actually use ratings? So do you use them a lot? Do you not use them a lot? How do you see them? When you look at the methodologies used, do you see ways that you do it differently in-house that you think are important to think through? And also that what came up a few times were comments about fallen angels. Not everybody may not know what those are, but those are credits that go from investment grade to sub-investment grade, where either sometimes through regulations and sometimes through the investment mandates, investors are forced to sell when it goes to sub-investment grade. And so is that an issue that's important to you? And how do you think about that? So over to you, David, for your thoughts on the conversation up till now and the questions that I just asked.
Thanks, yes. That's a lot on the agenda. And I just want to say thank you to you and to the UN DESA for inviting me in for hosting this panel. A lot of really important, compelling stuff has been covered. I work, as you said, for Aviva Investors, part of Aviva PLC. The history of the group goes back over 325 years, so it is doing something sustainable. But my comments are my own. I'm not an official representative right now of Aviva. And yeah, first of all, in many ways, I think credit rating agencies are, playing a pretty important role in sustainability, and obviously ESG. They're gathering the information and standardizing it, defining it, and selling it. So we do use it as part of our assessment, partly also because we're benchmarked, and it's not so much the power of the credit rating agencies, but their links to the index system and how investors use indices, I think, that make things like cliff risk such a problem. And maybe we'll address some potential solutions for that too. And ESG scores, as both S&P and Moody's commented, they're now integrated and considered in credit ratings. But I think we also can pretty much see that in terms of reaching the UN and the global sustainability goals and the 2030 goals, they can only be part of the solution. There are too many mixed incentives and conflicts of interests involved, I think, for them to really be the main part of the solution. And I think that goes to private finance as well. We're doing our best. Our investors and our stakeholders want us to do more. But yeah, I think Stephanie Griffiths-Jones alluded to this. At the end of the day, governments have to do more if they want kind of real solutions to emerge. One of the things we've also seen, and there have been reports on this, is that once you integrate ESG more comprehensively into sovereign ratings, the impact is often negative because the ESG scores and the credit scores are doing different things. And you have often, especially for emerging markets, highly negative environmental and social risks. And on the governance side, there's often weak governance, and shining a spotlight on that has a detrimental effect on the assessment of sovereign credit quality. Yeah, and some examples are in South Africa, the social instability risk, or Turkey's governance risk. But so at least we have a starting point with a coherent data set and that's acceptable to governments, regulators, and policymakers. But the conflict of interest is there are two sets of customers. One is the demand from issuers, both corporates and sovereigns, but also the investors that are paying for the ratings and the information. And so, yeah, I think it's important not to expect too much from credit rating agencies and to figure out what they are doing wrong or what they could do better. And ESG overall, BlackRock's former head of ESG, Tariq Fancy, has written a long essay about some of these things. Shari, for your question about how much do we use credit ratings? Well, we try not to take them too seriously. And I think aside from CDOs that have ratings kind of hard-coded, most active managers, just like ourselves, we do our own homework. We have internal ratings or internal scores and forecasts. We're trying to be superior and faster than credit rating agencies and adjust for market pricing. And market pricing is usually, a step ahead of rating agencies, and they take into account spreads as part of their rating assessments anyway. Then again, the real power is because benchmarks and passive indices are using them and changing their weightings based on that. And that has a big cliff, particularly around the drop from investment grade to sub-investment grade, which is, it's only a label, but it's become very important and part of the system. So the credit ratings and how credit rating agencies measure sustainability or produce ESG ratings, they're related but different things. I think if you want them to work together, you have to give incentives or disincentives for spending or not spending on certain goals. And one thing that I think is not being taken into account is that in environmental issues and energy security, social responsibility and equality, and responsible professional governance, they do lead to better quality, faster and less risky economic growth. And there's a lot of academic literature on this, but the problem is that standard credit metrics like reserves to external debt or the debt dynamics, those types of things are still more subjective, less quantifiable, and their effect on default probabilities and credit spreads, they are harder to quantify. And regulators kind of insist on transparency. And as investors, we also kind of struggle, especially with some of the ESG ratings, about confused definitions. And even worse, I think a large investment in environmental issues, to take an example, or to produce a more equal society, that's often seen unfavorably from a bondholder's perspective. It's a cost. It's going to worsen deficits and debt. And so it's often penalized. And for especially many smaller countries, it barely dents the global problems. So the other big problem is that, to find the solutions, you often have the collective action problems. And ratings agencies, I don't think, should shy away from such conclusions. As Francesco said, sometimes the threat of downgrade shines a light on the real problem and the need for joint efforts and coordinated solutions. And a big part of that can be that things like the carbon transition costs for poorer countries, as COP26 highlighted, they just need to be funded by the rich countries, or else they won't get done. The goal of 100 billion of funds per year to help with that, it's still a long way from being met. Investors also, I think, have a role to play, and Aviva has been, pretty vocal about wanting it to be, part of the assessment that we make. But again, if you're first and you're not investing in countries because they're committed or too committed to certain goals, you're opening up space potentially for your competitors. So again, it has to be kind of done in a coordinated way. Then, I do want to end on a slightly better note, which is this development of green bonds and social investment or sustainability-linked bonds. It's promising. It's growing fast, and it's not just for the management charges and fee bonanza that I think some managers and credit rating agencies might be salivating over. There is a real need to finance those investments, and I think it's definitely part of the solution that a large subset of investors want to try to use finance as a tool to achieve and promote those changes. When you look at green bonds, their yields are often well below regular bonds, and that provides a strong incentive for governments to both find the projects and the goals that allow them to commit those funds and benefit from that lower cost of funds. Ratings agencies, part of that role is to keep them honest, make sure the asset class itself develops in a sustainable way, and not chase their own profits and market cap and market share the way they did in the real estate and CDO bubble. So yeah, I'm sure we can return to more ideas in the follow-up. So thank you again.
Great. Thank you, David, for your comments that I think were extremely helpful for everyone listening. And I want to start with this question, the comment you made early on that ESG has been shown to lead to faster growth. And particularly, I think earlier, I'm not sure who said this comment that they have, I think it was one of the rating agencies, I think it was S&P, our colleague in this panel, who mentioned governance issues have been brought in because they can increase sustainability and growth. And I think that links very much to the question of investment that we were discussing earlier. How does one bring that in? Because it's ESG can lead to greater growth and greater sustainability, credit-wise, to greater ability to repay one's debts. So can investment. And finally, so can the investment in society, in inequality, et cetera. There's a short-term cost, but hopefully a longer-term benefit, but a very long-term benefit sometimes in terms of sustainable growth, fewer political economy issues, et cetera. And so this question of how does one bring these impacts, these long-term impacts into the thinking when we have markets that are tending to look at the short-term fiscal, are overemphasizing the short-term fiscal side of this. And one of the reasons we're so happy to have you here from Aviva and also in the first panel, our colleague Hiro, is because to think through, to have the really long-term investors, those with long-term capital, who are very interested in the long-term impacts, how they can, Hiro had mentioned that they should be part of the conversation because their interests are aligned with these long-term development issues. It's not just Professor Sachs and the development community saying we need to be concerned with this. Long-term investors who are thinking about returns to their beneficiaries over very, very long horizons should also be thinking about this. And so how do we bring those interests together? And finally, you mentioned, I think the issue you brought up about passive managers and indices is really important. I think a lot of people don't realize that that's how important that link is to the ratings and why that brings ratings so much into the markets. And because passive managers have been increasing over the past years, it's one of the background papers as well, looks at some of this data. And then there's another question that we really haven't discussed yet, which is the impact of technology going forward. As more and more, and we don't know, but it's possible that more and more strategies will be driven more and more by some element of technology. It's bringing this sort of more passive element or lack of into the allocation decision, the investment decision, and will that impact, and how will that impact the impact of ratings going forward? And so it could make it more impactful, as we just noted, or it can make it less impactful because they're using other mechanisms to think it through. So just to say that those are some of the issues to think through. And our final, and maybe we can discuss more in the second round, our final participant in this panel is Ms. Ramya Vijaya, who is the chair of the Department of Economics from Stockton University. And over to you for your thoughts really on just the whole conversation so much, and also for what you think some of the solutions might be. What changes to credit ratings do you think could help the market promote more stable and sustainable finance for developing countries? And what can policymakers do to bring around these changes? So over to you, Ramya.
Thank you. Can you hear me?
Yes, we do.
Thank you for inviting me to this conversation to provide perhaps what is an outsider's perspective to a largely industry and stakeholders panel. It is rather fun being the final speaker here. I think most of my work is already done, and certainly Jeffrey Stack stole my thunder. He mentioned most of what I have been wanting to say. But in my few minutes here, I will certainly re-emphasize what he mentioned about the primary issue being the lack of a development framework here. I particularly want to recognize the importance of the development framework, more specifically, a human infrastructure for sustaining economic growth and the critical importance of allowing fiscal space for investing in such human infrastructure. While the COVID pandemic has brought into sharp focus how important healthcare and overall infrastructure is for sustaining the entire economic system, it has also exposed the woefully inadequate investments in such infrastructure in countries around the world. But this should not be a surprise. This has been a long term in the making. Repeated and decades-long emphasis on a narrow and flawed conception of fiscal prudence has forced this neglect of such vital investments. Credit ratings have played a critical role in the punitive institutional ecosystem that enforced and continue to enforce such indiscriminate emphasis on fiscal prudence at the cost of vital human development investments. Even as we convene this panel today, we're in danger of going back to this unsustainable path. I'll give you just an example. A recent Latin American Outlook commentary by one of the rating agencies notes in the negatives for its outlook, the worrisome aspect is that the post-pandemic pressure for social support of a more long-lasting nature is considered to be the problem. Further adds, such pressure could reduce urgency for further efforts to reduce fiscal spending. They also note that Brazil's decision to alter its spending cap to accommodate new social spending is an example of concern. In other words, it is back to business as usual, where social spending is seen as bad or profligate to be punished with ratings downgrades. This language is the problem. This language must change. This language is part of the deeply rooted systemic bias that forces a harmful short-term outlook while stifling fiscal space for the very kinds of spending that can sustain long-term human development and economic growth. The looming threat of downgrades over what should be considered good and even vital investments is a big problem. In my own research, I have found that over the long term, ratings downgrades tend to lower public investments on healthcare rather than bring about any tangible improvements in fiscal performance. Many developing economies were not even allowed the fiscal space to deal with health investments during the health crisis during the height of the pandemic. With threats of downgrades and actual downgrades for actually increasing even short-term spending on healthcare during the pandemic. This kind of short-sighted view hardly provides a good signaling mechanism in the market, since without a focus on recovery of health, there can be no possibility of long-term economic recovery. As Mr. Mizuno said in the earlier panel, talking about incentives for asset managers to demand change, this is the primary incentive. Recognition that long-term growth cannot be sustained without supporting human infrastructure. It is also important to note the big discrepancy or double standard that several others, among them the Indian Finance Secretary, recently called out. Wealthy developing economies with much larger debt to GDP ratios were able to raise and spend an average funds worth about 12% of their GDP on COVID relief without similar threats of downgrades. This double standards in terms of the availability of fiscal space is a systemic inequality with significant consequences for economic recovery and long-term growth that must be addressed. So how do we make the market and investors value such long-term investments? Well, we first need to change the language around what is considered important. The current rating frameworks are heavily weighted towards penalizing countries for any expansion of government spending. For low-income and developing economies, the debt burden, measured by the GDP to debt to GDP ratio, is given a greater negative weight in comparison to developed economies. This is something I believe Jeffrey Sachs also noted. They're automatically placed at a lower level, which is really scandalous. Any increases in government spending and borrowing therefore leads to greater and more frequent threats of downgrades. Rating agencies claim to take a more long-term view of debt burdens to accommodate the need for cyclical downturns. However, no actual distinction is made between spending for crucial development infrastructure and crisis relief and other kinds of government spending, from other kinds of government spending. So in other words, all spending is lumped together in the debt to GDP ratio, and any increase in spending is viewed with suspicion. Even when fiscal effectiveness is part of the ratings calculations or the methodology, as someone had mentioned earlier, the metric used is primarily expenditure targets or caps, not actual effectiveness in terms of actual outcomes for health, education, or other intended development goals of fiscal policy. This is clearly contrary to the decades-long emphasis on human and sustainable development indicators emphasized by various UN agencies. It is also once again a flawed signal since it does not actually convey effectiveness of governance. Changing these indicators in a more transparent and consultative manner is the dire need of the day. But we certainly need to go into much more technical details on this. I would just continue to re-emphasize that this methodology that people have spoken of repeatedly is really broken. While these changes in methodology have to happen now, this is the bare minimum. Even previously in the wake of the 2008 financial crisis, we saw that the G77 countries had already called for greater cooperation in regulating credit rating agencies. It is now more urgent than ever for countries to coordinate and build on these earlier initiatives. One option is the establishment of an intergovernmental commission, perhaps under DESA, but more specifically with a specific timeline to examine the recommended changes to ratings methodology. Because we cannot continue to wait for the next crisis. We should also consider providing support for proposals for establishing alternative agencies like the one proposed a few years ago for a BRICS credit rating agency, or the more recent African Union proposal for a regional credit rating agency. Collective effort is required to ensure that such efforts gain credibility and trust with international investors. A yet more powerful reform would be establishing an international public rating agency at the UN with buy-in from all the countries. This has been recommended most recently by a few different UN agencies. Such agency could not only provide objective and expert ratings for sovereign issuers, keeping in mind long-term development perspective, but it also provides the required competitive fuel to encourage and indeed force private agencies to do so at a much more expeditious manner. Actually, I would like to end now by simply stating that we simply cannot wait for the next crisis, and this conversation must produce real results. Thank you, and I will stop here.
Great, thank you so much for your comments. A few thoughts. So I think that this issue of, well, you brought up also the issue of ratings on policies. So very similar to market discipline, this issue that ratings can actually lead to more, I don't want to say austerity, but more tight fiscal policies than may be warranted for long-term growth. And this was a reason why as countries are getting more countries are getting ratings, there's often been a recommendation that not to get a rating unless you actually are issuing debt on external markets and you need it, because it does cause certain impacts possibly on policymaking, which can have positive effects, but also can have negative effects, particularly when it leads to austerity, when there needs to be investment for growth and for social needs of the population. The second issue I think that's coming across uniformly in the discussion is really the importance of how money is used, how it's invested, and how does one better take account of investment in long-term sustainable development and growth, which is in the investors' interests, which is in the people's interests, and which is in the government's issues. So it's really everyone's interests are aligned if we have a long-term horizon, and or more aligned if we have a long-term horizon. And the question of what does it mean to have a long-term rating, that's a tricky question, but there are thoughts about using scenario analyses, et cetera, look at returns, how different countries would fare under different types of shocks, to try to begin to think about a long-term rating. But then the question is, how does one bring in the investment side and the side of this that's when the social spending actually, as it helps in the long run to lead to a more sustainable society, and should therefore help to be able to a country to repay its debt. So I think these are, we have on our second round, we don't have that much time. We want to open up the floor for a few comments. We don't have very much time from member states who are here. So I just want to give everyone a chance for a second round to really go through some of the issues we've been discussing. For His Excellency, do you think that you and your peers need a way or to communicate better to market actors and rating agencies with your prospects and plans, as we heard happens much more with developed regulators? And can the international community help with that? For our colleague from Ms. Dmitrievich, to really just to respond to all these comments and thoughts and this idea of long-term ratings, and is that something that's possible? How do you respond to any of to the comments made? And also for David and Francesco, thinking through one of the questions that came up was a solution to the cliff edge issue, and are there ways to address that? And finally, I'll just say that with the comment about alternative rating agencies, public rating agencies, if anyone wants to comment on their thoughts on that, it could bring in different new conflicts of interest that would need to be addressed, and governance issues, as well as it would have to have the confidence of investors and to be used. So there's no point in developing a rating agency if it's not used. But one of the points made in the background papers is that in a sense, the IMF already does analyses of countries, and those are taken seriously by markets. And so how does one think about that in this context? And are there ways to think about using public debt sustainability analyses that already exist, if they're comparable, to compare so we can better understand the value added of rating agencies versus model-driven approaches? So over to the colleagues in the panel. I don't know if you want to raise your hands, or if maybe I could go first to His Honorable His Excellency Mr. Manning, to give some thoughts on the discussion so far. I don't know if His Excellency wants to make any comments. If not, does anyone else from the panel want to have any? Yes, great. Go ahead, Alexandra.
Been lots of really important and interesting points in this discussion. So I'm just, there are lots that I'd like to say, but let me just try to focus. I'd like to address maybe the question on the methodology, and as well the question on the approach to long-term risks. The first point on the methodology is first to remind that credit ratings really measure the ability and willingness of an entity to repay its debt in full and on time. So it's actually a very narrow measure compared to a lot of things that we've discussed. And the methodology to assign ratings to sovereign is based on an analysis of all the sovereign defaults across 100 years in history. And every year we look at the rating transition, we look at the default, and we assess if it's in line with the definition of the ratings and with the methodology. GDP, debt to GDP is actually, if you look at the history, and I'm sure everyone has read the, Reinhardt and Rogoff here, the debt to GDP is actually not the main factor that drives sovereign default, and that's why in our methodology we reflect the factors that over time have been the main drivers. Our methodology is based on 4 pillars. We look at the economic structure and the growth prospects. So it's very much forward-looking in terms of the economic growth. We look at also the stability of the institution and the effectiveness of the policy making, there again, a lot of the defaults actually come from these factors. We do, of course, look at the fiscal performance and the fiscal flexibility as one of the elements. But another important factor here is the monetary flexibility, and the last factor is the external imbalances. And just would like to maybe then link that back to the question on the time horizon. And also maybe, commenting on Mr. Mazzaferro's comment around COVID. I think it's maybe an illustration of how the ratings approach work and the impact of the time horizon. So in a case like COVID, where there's been a major sudden exogenous shock to the global economy from the pandemic, the monetary flexibility and fiscal flexibility has been mentioned. The extraordinary monetary and fiscal support have enabled the global economy to breach this period of essentially halt in the global economy and limit the implications on the companies, on the people, and ultimately the economic fabric. And that's where, for sovereign ratings that had sufficient resilience and flexibility, we've had that view over the longer term as to this has been necessary to enable to bridge the gap and ensure that the economy goes back on its previous trend growth. As you get lower down the rating scale, lower ratings mean that there is more vulnerability to this external shock, and there's also less flexibility and resilience. And that's where there's been more of the volatility, both in corporate ratings and in sovereign rating. And actually all of the sovereign or corporate that defaulted had been rated speculative grade before the pandemic. So in terms of how we look at the longer term risks, I think there's been a lot of learning for everyone in the market, in policymakers in the past years with the pandemic, about the importance as well of natural capital. You spoke about human development, but natural capital is another factors. And there is an increasing focus on managing that transition towards net zero and implementing some measures to mitigate or limit climate change. These are very important factors. We investing, it's one of our priorities this year actually, is really to enhance this analytic of the climate impact. But this is difficult. These are risks that where there is no track record. What's going to be key is to have more, maybe we mentioned new technologies, scientific advances that enable a better measure, as well more transparency, more disclosure. And as we get more visibility on this risk, on their materiality, we can start reflecting them into the credit rating, looking both at the exposure, but also very importantly at efforts to mitigate this risk and generally the resilience. So all of these are factors that we're looking at. But really, if I may conclude here, that we're convinced that building this more sustainable world and global economic transition can only be reached through a truly collaborative approach. We're very engaged. We're part of a large number of groups of dialogues with the TCFD, the EU high-level expert group on sustainable finance. We're very engaged with the Central Bank Network for greening the financial system, the IASCO, the FSB, and also at the end of last year, we've joined the Glasgow Financial Alliance for Net Zero to support our common goal of resilient and sustainable future. So we take this very seriously. We invest and continue to increase our capability to provide insight and transparency on this risk to the market.
Great, thank you so much, Francesca, for those, Alexandra, excuse me, for those very helpful comments. And those additional thoughts on the issues. I want to say two things. We don't have that much time, but I know there are some member states who had requested beforehand to make some comments. So if they are here in the room, you can raise your hands, and then you will need to be unmuted. So hopefully that will work. But if there are member states who would like to give some comments, please raise your hands and we will see if we can make that work. And in the meantime, I don't know if Francesco or David have any additional comments they wanted to add as well to the conversation.
Well, I will be very, very brief. So you were asking me what to do I mean, to reduce the cliff edge risk. So I have to tell you what we are doing, and I'm not sure it's always useful, because of course it refers more to our to our experience. So as I was saying, we are using a lot of stress testing, and we are trying to identify, if these things happens, what are the parts of the financial sector which are the weakest. Then we try to create resilience there. So sometimes risks, the materialization of risk is inevitable, and what you want to avoid that this destroys the economy, and in particular that this destroys the economy through the financial sector. And so this is what we are trying to do. I'm not sure this is always useful for other cases. Wanted to say, however, and I think we have not been speaking today much about the SDR allocation which took place recently. And if we are thinking about what could be an equivalent policy to the ones which have been made by European governments at the time of COVID, so having the public sector playing a good role, then I would say that we should think on how to use that money well. Because then, of course, this is the first line of defense which exists and should be used. Thank you.
Great, thank you so much. And I think really bringing in the importance of thinking of private finance overall, credit ratings, and then private finance is really part of a bigger framework. In fact, the Addis Ababa Action Agenda really tries to bring all this together, the importance of public finance, in this case at the SDR allocation, the important role, as Stephanie Griffith-Jones would say, of development banks and thinking this through, and how do we really bring the public-private together to think together about the importance of how does one bridge the gap and have long-term affordable financing for developing countries, including thinking about concessional finance and ODA. David, I don't know if you had any last comments before we go back to Professor Sachs for his some additional thoughts from him.
Yeah,
As
sure.
I don't, yeah, great.
I'll try to be brief as well. So on the cliff edge, public institutions, in particular, public pension funds, control trillions of dollars in AUM, and they should take the lead on a lot of these issues, and a lot of the private sector will follow. So on the cliff edge, they should either design their own benchmarks that don't have forced selling the minute something goes to BB+, or push the index providers to phase out the weightings slowly over time, or something like that, or combine, and no longer invest in purely investment grade indices, because that would remove a lot of the forced selling. But again, I think it's just something that they've forced themselves into and created artificially. In terms of longer term investment and the transparency we need from ratings agencies and others, including I think the IMF on debt sustainability, there is academic literature that cash transfers to poor households, while being expensive, produce good economic outcomes and increase social stability and so on. And longer term investments in decarbonization, they look costly, but there's an obvious carrot that countries like South Africa have gotten from shutting down coal mines, that can make a loss of revenue and a potentially costly decision, have that incentive and have less of a financial impact. And then finally, there's a stick, which is the cross-border carbon taxes, which it's going to be very tough to pass in the US, but the EU is probably determined to lead the way on that. And again, what we need, given the analysis that the ratings agencies are able to do, is to explain how those things are being taken into account, and that at least that's a step in the right direction. But again, I think looking for them to have or to be a major part of the solution is going to be tough. It has to be public funds and a global solution.
Thank you, David, for those comments. And I see that our colleague Jesse Walter from the US has put some comments in the chat. Jesse, I think you've been allowed to speak now. If you want to say the comments yourself, or I can read them. Sorry to everyone who's been putting comments in the chat that we're just going to the ones from member states, given the timing, but we are reading all of them, and we'll pass all of the comments to all of the speakers. So I don't see Jesse jumping in, but the comments are in the chat. Oh, and His Honorable Brian Manning would like to speak. Let me quickly just say that Jesse has a question about the panel speaking to transparency, good governance, and strong regulatory frameworks to improving access to resources. Recognizing that since the global financial crisis, the G20, through the Financial Stability Board, has reduced mechanistic reliance on credit rating agencies and standards, laws, and regulations, and that standard-setting bodies and financial authorities have strengthened the regulatory and supervisory framework for credit rating agencies, including with respect to rating methodologies, and that the U.S. supported this work and improvements in financial stability. And yes, that is I think that those points are very well taken and have actually, and I think that hopefully some of the panelists have already been speaking to those as we run short of time, but for the future, whoever is speaking now, the panelists, to also think about those questions and those comments in your final remarks. And over to you, His Excellency Brian Manning, for your final thoughts as well. And thank you, Jesse, for your comments.
Yes, hi. Thank you so much for having me this morning. I greatly appreciate it. Listening intently to a lot that was said. And, I wanted to reiterate exactly the position of many of the smaller states that tend to be more vulnerable to these credit ratings and also environmental impacts. But Trinidad and Tobago is in a situation where we produce hydrocarbons and we're a smaller state. And for us to fall into various brackets, there's always a concern as to how will this affect us with the inclusion of the ESG in terms of credit ratings. And that has to be considered. Yes, we do produce hydrocarbons, but we are not Norway. We're not Saudi Arabia. We are price takers. We don't set the price internationally for hydrocarbons. So we are affected when energy prices rise and fall globally, but we're also a smaller state, much like our CARICOM neighbors, Barbados, the Bahamas, and so on. And we can be affected by hurricanes, affected by other acts of nature, acts of God, and of course, as we've all been affected by a global pandemic. A lot of what we import in Trinidad and Tobago, a lot of the goods that we consume are imported. So of course, we have also become subject to imported inflation and other issues. So I would like the credit rating agencies to consider these nuances when they are creating scores. You couldn't penalize, we are an investment grade country now. Would we be penalized to the point for producing hydrocarbons where we're no longer an investment grade country? And how does that benefit us? Also, the other smaller states that are not hydrocarbon producers, but have had to borrow so much during the pandemic to keep themselves afloat, are they going to be punished for that? are they going to end up with a credit score that is so ridiculously high that if they borrow, they're simply submerging themselves into more and more debt, into a black hole that they may never climb out of? And that, to me, is not really the intentional purpose of many of the multilateral lending agencies. And it certainly, I don't believe it's the purpose of the credit rating agencies. So there's a lot to consider. I don't think these calculations are simple. They are quite complex, actually, but we must think about them carefully and do something that at the end of the day is going to benefit the countries in terms of development. Thank you.
Thank you so much for your final comments. I think that's the perfect segue to additional thoughts from Professor Sachs. So Professor Sachs, over to you.
Sherry, thank you very much. That was a wonderful panel. I have 7 quick points. First, to say that we're talking about 2 distinct issues here, the ESG issue and the sovereign borrowing issue. We should make sure that we keep these 2 distinct. They have very different ramifications. The ESG is about pathways to sustainability. The sovereign borrowing issue is about the plight of almost every low-income country and almost every lower middle-income country, the lack of creditworthiness and the implications for absolutely impeding basic sustainable development. And this has to be overcome. I'm going to focus most of my remarks on the sovereign risk issue. Second point, we know conceptually and empirically that capital markets are subject to self-fulfilling crises. Of course, we have seen many of them. A self-fulfilling crisis is a crisis in which lending stops because of the fear of default, and the stop of lending drives the system into default. And this is part of capitalism for 200 years. There are remedies for it. Lender of last resort financing, ensuring liquidity, avoiding cliff risk regulatory measures, and so forth. We do not solve this problem yet for the low income and the lower middle income countries. What Mr. Mazzaferro said was very interesting. He explained how the ECB made sure that European countries did not face cliff risk. That is the job of a great central bank, and a central bank can stop this. But I'm sorry that that is not feasible for any low-income country or any lower middle-income country unless the ECB or the Fed gives an open swap line to those countries. And it does for a few that are geopolitically important, but not for most. For that reason, poor countries are vulnerable to self-fulfilling crises. As a result, they get low credit scores. As a result, they borrow short-term and at high cost, and as a result, they often default. We are trapped in a bad equilibrium. This is sound economic theory, and it is the history of the international credit system. What is the remedy? Well, print dollars. So if you're the Fed, you're fine. Print an international convertible currency. If you're the ECB and you take care of your member states like Greece, it's fine. But if you are the rest of the world, you are stuck without development right now. This is a broken system. The fact that the sovereign credit rating system says, well, we just measure default risk is fair enough, but not correct analytically, because the credit ratings themselves drive this world into 2 classes, those with liquidity and solvency and those without liquidity. And those without liquidity are half the world right now. We have no solution. IMF liquidity doesn't begin to compensate. The IMF, despite John Maynard Keynes' hope, is not a central bank, a lender of last resort, not even close. And so we have not overcome this crisis. There are many terms for it. One is cliff risk. Another is pro-cyclicality. Another is short-termism. But they all come to the same point, that countries are impeded from getting access to capital for development. And they end up with access only at very high interest rates and short-term maturities, and they stay poor. And this is the basic problem that we're confronting. Notice that the credit rating system, as I'll put as my third point, does not take into account time horizon of the borrowing. The credit rating system gives a score to a country, but if that country's borrowing 40 years or 10 years, it's still CCC or double B or whatever it is. There's no attention in the credit rating system itself to the term structure of the borrowing. This is a huge flaw. It's a conceptually broken model. It's using a simple arithmetical relationship to get a score. But it is not taking into account the time horizon of development. If we did, we would note that lending to a country for 30 or 40 years, during which time development can take place and liquidity risk would not take place because it would be a long-term loan, would make a lot of sense. We need longer maturities and less amortization and fewer cliffs, and then we can get development properly financed. But the current system will not finance the development. The credit rating agencies should understand they are part of this self-fulfilling division of the world. They need to understand that. And the way that their credit scores work amplifies this. I'm looking at Moody's score, for example. GDP per capita has 35% of the weight of the first factor, economic strength. If you're poor, you are downgraded, period. Scale of the economy has 30% of the weight. If you are small, you are punished. If you are small and poor, 65% of the economic factor is already against you. So the credit rating system virtually guarantees that we don't have development finance. Now, also, there is no long-term development framework for financing. And sadly, that's true at the IMF and the World Bank as much as it is at the credit rating system. The IMF's World Bank DESA system is a short-term analysis. It looks also at the coming 10 years. It hardly even asks the question of whether the borrowing is for long-term finance, because it's just an extrapolation of short-term GDP accounts. So unfortunately, the IMF and the World Bank DESA have not solved this problem because they don't use a model of development either. But they could, and they need to. And if the credit rating agencies and the Bretton Woods institutions had a development framework, and if the major central banks also understood that development framework and supported it, we could have a system of long-term finance that would be low risk of liquidity crisis because there wouldn't be short-term amortizations. And that, if we can understand that it is safe to lend to poor countries if the money is used for development finance. And not only safe, but absolutely necessary for electrification, for infrastructure, for digitalization, for children in school. And as long as there isn't amortization due in the next 3 years, 4 years, 5 years, but in 25 years, then a country will have the scope for development without an intermediate credit crisis, because there will be no cliffs possible on that kind of lending. But we haven't built that system. So my fifth point is we need credit ratings that are paired by the agencies and the Bretton Woods institutions that take into account the tenor of the lending, the interest rates, which also are not done except in a self-fulfilling way, and the purposes and governance of the long-term finance, so that we have a development framework that is properly being financed so that today's low-income countries and lower middle-income countries can get out of the poverty that they're in right now. We need liquidity. The thing that keeps the United States mostly out of trouble, or the ECB mostly out of trouble, is liquidity provided by the central bank. That is the great privilege of having a tradable currency. By the way, even when our major country, when it fails to operate with lender of last resort protocols, it can get into a self-fulfilling crisis the same way. The Greek debt crisis was a self-fulfilling crisis. The 2008 Lehman Brothers crisis was a self-fulfilling crisis in which our Treasury Secretary unaccountably decided to drive a central bank into bankruptcy. Not a central bank, I mean a key bank, into bankruptcy one weekend, and then expose the system to a self-fulfilling panic, which was then overcome when the Fed opened the spigots, but it was already too late to avoid a major global contraction. So lender of last resort is key. If the IMF played that role, we'd have a different world. That's what John Maynard Keynes tried in 1944. He didn't get it because Harry Dexter White said, no way, we're not going to have a central bank other than the Fed. Thank you very much. The US dollar will run the system. The US dollar takes care of its friends. If you happen to be on a Fed swap line, you don't have self-fulfilling crises. A few developing countries are. They are the allies of the United States. But if you don't have a swap line with the Fed, then you end up outside of the international financial system without creditworthiness and without development finance. So my final point, and just to close, is we need a new system. We need a system of long-term financing of poor countries because they need electricity, digitalization, children in school, clean water, primary health care, and all of this is affordable, financeable, necessary, and solvent, but not on a 5-year loan, on a 30-year loan, on a 40-year loan. And pension funds can provide that financing, but not when they are facing sub-investment grade. And the credit rating agencies are trapped. They don't do development finance. They don't do development economics. They look at frequency of defaults. So they're looking backwards. We need the Bretton Woods system, the UN, and the G20 to say, here is a development framework for long-term sustainable development. Here is why this is prudent and solvent, but that does not require Ghana or Trinidad or other CARICOM countries to pay back loans in 3 or 4 years and to have cliffhangers of whether amortizations will be refinanced or not. We need to move away from such a system. We need to move to long-term financing, and I think the credit rating agencies can be good partners in that. They won't lead it. We need the official system to lead the change, to understand, conceptualize, and create the institutional framework for long-term development financing. If we don't do it, we have half the world that lacks the finance to get out of extreme poverty, and that's precisely what's happening right now. So I'll stop there. Back to you, Sherry.
Thank you so much, Jeff, for your comments. I think that closes the discussion. We're going to pass the floor in 2 seconds to my colleague, Naveed Hanif, the Director of the Financing for Sustainable Development Office in DESA, to close the meeting. I just want to note that, as I said at the very start, We lead the work of the Interagency Task Force on Financing for Sustainable Development, which includes the entire UN system, the IMF, World Bank, and more than 60 agencies. And we've had many of these discussions within the task force. And one of the issues that came out was this discussion of, is it helpful to have long-term ratings next to a short-term rating? What does that tell you if we have that? And some colleagues say, well, if there's a high short-term risk of default, what good is a long-term rating? Because if you default in the short term, it affects the long-term bonds as well. The other side of looking at that is if investors see that a country has an investment-grade long-term rating, then there shouldn't be a short-term problem, because the market or the international system can lend without the risk of default. It's a liquidity problem, not a solvency problem, if the long-term rating is higher. And so not to think of that as a sign that, well, we don't need the long-term because of short-term default. It could help us get out of a short-term default by indicating that the short run is just a liquidity problem that we can solve. So with that note, I'm going to pass the floor to Naveed Hanif, the Director of Financing for the Director of Financing for Sustainable Development Office, to close today's meeting. And thank you so much to all of the speakers for this really excellent discussion. And really also thank you to my colleagues, Peter Chawla, Benda, Gia, and Pauline Ning for organizing the meeting. And over to you, Naveed.
Thank you so much, Sherry. And I want to thank you and Stephanie for the outstanding work that you did in conducting these discussions. And on behalf of the United Nations, I want to thank all panelists for joining this conversation and sharing very thoughtful ideas with us. Professor Sachs has made my task very difficult. I cannot give such a powerful closing statement, but and Stephanie and Sherry, you have been capturing the key points very well from the panel discussions. I just want to focus on 4 headline messages and see what the way forward looks like for us as United Nations and all stakeholders around the table to advance this work. First, everyone around this table is very open-minded and willing to look at options to improve this area of work. That's commendable, but we have also realized, and change is happening, but the scale and speed of change are not commensurate with the urgency of action that's needed and the challenges that we are trying to address. So openness is welcome. Willingness to engage is also very encouraging, but scale and speed need to go up. Second, and I fully agree with Professor Sachs, we need to keep the ESG distinct from the sovereign borrowing problem. At the same time, ESG is a good starting point, but not the end game. Sustainable development goals should be the framework. And Alexandra made that point. It's not just for rating sovereign, it's the integration of sustainable development goals as a way to evaluate a country's ability to pay back. So that means longer time horizon. Sustainable development requires long-termism, and that was very clear. Third headline message, asset owners, managers, regulators, governments, civil society, everyone has to be part of this conversation. We need to bring them together. The minister from Ghana said, voices are missing in this conversation. Capital exporting countries have a major say, which is understandable, but capital importing countries and all other institutions that have a role should be around this table. So it has to be multifaceted, multi-stakeholder conversation. Last point, number of ideas were floated. Create a platform, create a commission, create a task force. We need to follow up on this conversation by recommending to the Secretary General to create a platform, whatever form it takes, a task force or a commission, which can bring all actors around the table, inject the urgency of action, and clearly state we need tinkering on the margins will not help. We need to rethink the model. We need to reconceptualize the work that not only CRA is doing, but all actors in the market are doing who are critical for providing development finance. So once again, thank you so much for your presence, engagement, your thoughts. And as I mentioned, we will try to ensure there is a strong follow-up to these conversations. Have a great day and look forward to working with you further on this issue. I also want to thank Sherry and the whole team for putting this together. They did an outstanding job, not only in conceptualizing the conversation, also bringing all of you around the table. Thank you once again. Bye-bye.